Fed here who's not backing down.
What is the market saying? I don't believe you. It's pricing in rate cuts. It's already seeing the data roll over.
The way they're feeling now is comfortable that they've maybe done enough or getting close to having done enough.
At some point, you have to move to 25 because you've done a lot. You don't know how much damage that you've done.
Expectations for the remainder of the year for 2023 are quite bleak. Earnings are supposed to go down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. This is Bloomberg Surveillance. Jonathan Ferro in London. Lisa Abramowicz back from the Alps, and I'm Tom Keene. I don't have a life. I did absolutely nothing, unlike London and the Alps. We welcome all of you. John Ferro with us here, coming up on foreign exchange, an important discussion with Jeremy Stretch. And we say, welcome back from Happy Valley.
Thanks. It was kind of happy, actually.
Were you the
People were
gloomiest
optimistic.
person in the Valley?
You know, no, because there were some people who, under the breath, said that they did expect things to turn. What I thought was interesting was the divergence between the economy versus markets. People more optimistic on the economy, markets not so clear. And that's where the divergence really seems to be.
Well, we get started on a week here of economics, finance, investment, lots and lots to talk about. But let's link it into maybe the key statistic, and I think a surprise for our viewers and listeners, Lisa, and that is simply Q4 GDP, first look, 2.7%. I guess that's a recession.
Yeah, well, this to me is the compelling aspect.
Do people know this?
Well, look, how much do we end up with some sort of recession? How much do we end up with a better than expected outlook, right? Which is really what a lot of people are expecting because people still kept going out and spending, and we are seeing weakness, but it isn't really coming through in force. But really, this goes back to this idea of profit margins being crimped. Morgan Stanley, the House had two reports over the weekend. One, from the economics perspective, we could get a soft landing. From a markets perspective, Mike Wilson, we're still going to get that drop off in earnings, and we're going to see it in this quarter.
Yeah, well, it's interesting. I thought, you know, and John, if he was here, we'd talk to him about it, but he's in London. And what I love about him, Mike Wilson, is he's waiting for the last stage of a bear market. He's not saying it's here now, but he says you need that, and we're not there yet.
Companies aren't going to lay off workers as quickly as many people had in the past because they know what happens. You can't hire them again. They also want to remain competitive, so they're not going to necessarily raise prices as much. You're not seeing the same kind of margins as you did last year. So so earnings could go down even as the economy kind of muddles through.
Well, that's going to fold into the economic data of the week. It's an important week of economic data here to the February 1st Fed meeting. I mentioned the GDP statistics. There's some S&P PMI numbers that John believes in. I'm looking at retail inventories is an interesting dynamic. Claims, while you were gone, we had a 190 print on claims.
I know, I saw that.
Shocking.
It was shocking. Wasn't the labor market supposed to weaken? At the same time, there are a number of reports coming out. It's taking longer to really get a new job. It's taking longer for companies to decide to hire people. So softness around the edges.
Framing on a Monday here on a full work week, 5-day work week, something odd. Let's look at the equity markets here. -5, Dow futures, -12. The VIX really doing nothing, 20.27. Dollar weaker. Again, John Ferro coming up with Jeremy Stretch of CIBC. 2-10 spread, real yield, not giving me much love this morning. And Lisa, an elephant in the room, climbing up. Brent crude, 88.20.
The highest going back to November. And this, to me, is one of the most interesting elephants in the room. When does the inflationary element of the reopening of China start to bite in a more material way in the expectation of a happy landing, of a happy existence that a lot of people are putting out there? I do want to give you a sense. Today's kind of a slow day, and this is the quiet period for the Fed ahead of their next meeting.
We wanted to ease back into it.
So I wanted to give you a sense of what we're looking. No, it's not auction-free. This week, there are 3 auctions, and I'm most interested in the 5-year. So there's a 2-year, $42 billion of 2-year notes being auctioned off tomorrow, $43 billion of 5-year notes on Wednesday, $35 billion of 7-year notes on Thursday. 5-year yields is where I'm interested. How much do people buy this story that the Fed, the ECB, can get inflation under control? They're pledging to. How much are they going to pull their foot off the brake a little bit sooner than people expected? This week, earnings. Tons of them. We get Southwest, we get American, IBM, credit card providers, American Express, Visa, and MasterCard. But the ones I'm watching, Microsoft tomorrow, Tesla Wednesday, and Intel on Thursday. Those are the most interesting to me.
And this is important. Coming up later on the program, Daniel Ives of Wedbush here. It could be a 2-hour interview. I want to focus on Apple as the one company left standing in the layoff derby. What do you want to talk to Dan Ives about?
Whether they can still be the leadership, because that seems to be the message from the returns that we've had this year. also just want to say that Friday, 8:30 a.m., we get personal and income and spending, and 10 a.m., we get University of Michigan sentiment survey for January. Core PCE, how much is core inflation, the measure that the Fed looks at? How much is that coming in?
We get core PCE this week?
Yeah.
I did not know that.
Well,
okay.
the
There's
more
your
you
brief.
know.
Lisa Abramowicz back from Davos. We'll talk much more about lessons learned from the World Economic Forum meetings. One thing we know is a lesson learned is to listen to Margie Patel. She's at Allspring Global Investments, and what is so important about her decades of work is the fearlessness to mix from fixed income to equity. Margie, what is your weighting, your relative dynamic of fixed income versus equity?
We're geared over on the equity side. And we have been actually, even with the Fed increasing rates last year, the reason being rates were so low, we felt that there was just a potential to lose money on the bond side as on the equity side, and that really played out. And this year we see rates have come down quite a bit. So again, we think bonds are a okay bargain, but really nothing exceptional, particularly when we think we see better opportunities on stocks.
How does the angst, and particularly the tech angst, which is being underplayed over the weekend, I get that. How does that play into your core framework of dividend growth or use of cash?
I do think that we're going to see more of an emphasis on dividend growth and higher than average dividends for stocks that do well, particularly because we still have a lot of high PE stocks who need to have their PEs deflated, especially if we see lower earnings, which I think is a general consensus.
Well, but Margie, just to go back to what Tom was talking about with tech, will tech still lead in whatever rally we see in equities that you're expecting?
I think tech will lead certain sectors. I think the semiconductor sector will lead, although we may have to wait for mid-year to see more clarity about increasing demand. And also because the prices of those stocks are rather reasonable, the dividends are rather reasonable. We still think the high PE tech stocks may have some underperformance this year.
So are you basically rallying around the idea of these job cuts? Are they positive to you? Is this the washout, the cost cutting that you've been looking for? Or is this just a story that perhaps has been given up too quickly? Is there a distinction between the haves and the have-nots right now that you're highlighting in terms of what you're buying and what you're not?
Well, I think as far as job cuts, the market has generally regarded that as very good for earnings, but it telegraphs what those companies think their business outlook is. You don't lay off 10 or 12,000 people because you think you'll see a spring back at the end of this quarter. So that says to me companies looking at their business are looking to be more cautious.
So when you say that you don't like bonds and you like equities, what is it about bonds that you don't like? Is it that basically you think that people aren't pricing in the rate hikes? Is it that you basically just don't think that they're going to have the same kind of return profile? Or is it just that equities offer more in an early cycle kind of feel, which some people believe we're entering into or will by the end of the year?
Yes, I think you have to be early for equities because you'll never really catch the bottom. But really, if you look at investment grade, say A-rated, you're looking at, say, 2.25%, 3.25% for 5 to 10 year maturities. Those aren't yields that you can really say I can make a lot of money in. And even high yield double Bs are more around 6.5%, say 8.5% for single Bs with maybe 5 to 10 point discount. That's modestly attractive. Yeah. But if those do well, equities have to do even better.
Margie, over the weekend, I saw a massive effort to find some analog back to the Boston Tea Party over where we are right now. What's the analog you use in terms of saying 22, 23, and dare I guess 24 is like what? What's it like?
Well, it's not like anything because we never had a period of multi-year near zero rates and a deficit that's so extremely high at a time when the economy did okay. So I think that's what's different. I think people are banking too much on the Fed being more modest, a 25 basis point increase, and that will somehow cause the no recession to occur. So I think people are being too optimistic about that and not maybe cautious enough on what the damage is being done to the real economy that we're seeing in those early statistics that Lisa was talking about.
Tom, the Tea Party, what's the analog for that?
The Tea Party is the analog. It's the last time the Red Sox had a shortstop. Margie, one more question, if I could. On Friday, as an exercise, I looked at my bond portfolio. My long duration Austria 97 years taken a bit of a loss, but I think it's unknown how much investment grade quality corporates are down, down, down. Is it the mother of all times to buy quality investment grade corporates?
Well, I think they're really rather modest. Actually, the investment grade and high yield have done about equal to the equity averages, Dow and Standard & Poor's. And I think, as I said, the returns are rather modest. And I think that there's still some uncertainty about will we see rates actually begin to taper down, or will we see rates actually go up if we have higher defaults or much slower economy. So I don't see a tremendous opportunity in bonds at this point.
Margie Patel, thank you so much. I just want to say, folks, to give you a wisdom into the Boston market, Margie Patel was a young kid, and there was a triangle of fixed income excellence. Daniel Fuss, Felix Smith, and a young whippersnapper, Margie Patel, that made it the best fixed income block in the world. Margie Patel now with Allspring giving us wisdom there. What'd you learn there? I mean, with her experience, she's over in equity land.
What I think is fascinating is exactly that. She's 75% in equities, I believe, or something like that, even though her training really is in the bond space. What she said there, if bonds are going to do well, stocks are going to do even better. So why not just go stocks?
Well, that's a core thing here, but what I see is against a consensus call. But even while you were gone up Happy Valley, the basic idea here is everybody's on board bonds. All my radar's up.
I would agree with that, especially if you still have inflation and you still have central banks that are committed to doing something that potentially could be a lot. Did you know investment grade and high yield both gained about 3.5% in the first 3 weeks? That's the same as the S&P.
But did they give back in the last couple of days? I mean, high yield's like a rock, right?
Yeah, a little bit, but not that much. And what you can see is that people are still going in because they want the coupon, and they see that on a relative basis to the past 10 years, you're actually still getting yield.
On a Monday, get ready for Fed meeting, February 1. We're getting ready for that right now. Our team is working on a stellar group of the usual suspects. Looking forward to that. And we do that with a very busy week of economic data and conversation to drive forward. Dan Ives scheduled to be with us here with Wedbush, and Jeremy Stretch with our John Ferro in London in a bit. Futures a little bit of a loss, -7. The VIX 20.20. Yields can't get out of their way, 3.50% in the 10-year. 2-year, we're on that 3.99 watch. Forget about it. Backs up to 4.18%. Stay with us from London, from New York. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In California, authorities are trying to figure out the motive for a mass shooting in an Asian community near Los Angeles. 10 people were killed when a gunman opened fire in a ballroom during Lunar New Year celebrations. The suspect, described as an Asian male, was found dead of a self-inflicted gunshot wound. Poland will ask Germany permission to send its German-made Leopard tanks to Ukraine. On Sunday, Germany's foreign minister said if Berlin were asked about the tanks, it wouldn't stand in the way. The failure to work out an agreement on tanks has overshadowed pledges to send more military aid to Ukraine. China says more than 12,600 people died of COVID in the week before Lunar New Year holiday. It's likely the real death toll was much higher given the scale of the outbreak. Meanwhile, a top Chinese health official suggested more than 1.1 billion people had been affected since virus controls were dismantled late last year. The Justice Department has found more documents containing classified information at President Biden's home in Delaware. FBI agents searched the home for more than 12 hours. They're said to have found classified notes from the president's time in the Senate and vice presidency. Ken Griffin's Citadel made a record $16 billion in profit from clients last year, the largest annual return from a hedge fund manager. Now, it also surpassed the amount John Paulson generated in 2007 on his bet against subprime mortgages. Estimates from LCH Investments showed the top 20 hedge funds turned out $22.4 billion in profit after fees, but losses grew outside the industry giants. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
If one side thinks that the other one's more responsible for the debt, at $31.4 trillion, that is totally not accurate, and it's deceptive. We're all responsible. We got a $31.4 trillion debt. It's a runaway debt, and no one's holding themselves accountable. If you're going to use a debt ceiling for anything except for theatrics, okay, which is what probably might happen for a while, we're going to pass the debt ceiling. You are exactly correct. Right. It has to pass.
The gentleman from West Virginia, Mr. Manchin, on Meet the Press on NBC. It was good to catch up with him there. Thank you to many of the Sunday talk shows for their efforts on Bloomberg Radio. It's hugely popular, a Sunday redo there on Bloomberg Radio. And part of it is, well, getting together or not. And of course, Senator Manchin of West Virginia deep in that. Lisa, let's first go to something that I really think over the weekend was there, which is the trade idea that if we're not going to trade with China, who are we going to trade with? And Neil Shearing has a very thoughtful note out at Capital Economics talking about, is the next China Mexico, Vietnam, and in Eastern Europe, Poland as well. Shearing leaning there on the Davos trend of what's the next globalization look like. What did it look like in Davos?
China, that's what it looked like. Hard, absolutely full stop. And that's what I thought was most interesting. There are companies so hinged to China, they cannot afford to move away from it.
They can't go to Vietnam.
You've got auto manufacturers that, well, it's not just with respect to manufacturing, but it's also with respect to selling. And it's with respect to the political environment where if you don't manufacture, you can't sell there. And so it's really hard to see how it really diverges the West and the East in the same kind of way that people are talking politically when the business environment is quite different.
You and I know that there's early Davos folks, middle Davos, and late Davos, usually centered around the piano bar. But forget about that. China, what a splash at early Davos this year. Did that carry forward through Wednesday, Thursday, Friday?
That was the entirety of a lot of the conversations. They had a lunch with Liu He, the vice premier of China, with a number of the manufacturers, in particular the chip makers, to understand the backdrop of that. So there was very much a presence there, and there was very much a willingness to do business, which again raises a question of how does this bifurcation really come about?
I'm guessing Taiwan wasn't invited. Right now, we'll go to Washington, where she's always invited. Anne-Marie Horton joins us now, our Bloomberg Washington correspondent. We've been talking up on surveillance, Anne-Marie, the typical, usual changing of the guard, claimed Zients as chief of staff to the president. Let's begin with Civics 101. What does the chief of staff do?
This is really the top managerial role in the White House, and this is the individual that is the gatekeeper to the president, in charge of the schedule, in charge of who gets access to the president. So it's really a critical role. Also, part of that is going to be obviously outreach with Congress. So this is a really important critical role that has a lot to do with the ebb and flow of how the West Wing works.
I'll let Lisa go forward. Let me go back. Was Klain successful?
Many would say Klain was successful in the sense that look at the president's legislative priorities and what he was able to get through Congress, worked in a bipartisan way to get hard infrastructure done. And at the end of the day, they got their Build Back Better in a mini form done in the Inflation Reduction Act. And he also was able to make sure the president was on board, or really helping to get the president, helping the president get the rest of Europe and Western allies on board when it came to, obviously, Russia's invasion of Ukraine. So I think many would view him as being a successful chief of staff, even if they don't agree with his politics.
Anne-Marie, you mentioned a lot internationally, and that's really where I wonder where Jeff Zients comes into play, his new chief of staff, considering his lack of experience internationally. How are people concerned this plays into just the discussion we were having, trade with China?
I'm not sure people are concerned by anything with Zients in terms of international experience. This is someone who served on corporate boards like Facebook. He has deep managerial experience. He was a consultant. He was a founder of an investment firm. And anyone you talk to, and I've talked to a number of people this weekend, say that this is someone who he's known as Mr. Fix-It. He's able to get things done. So that's why a number of individuals are excited about his appointment, thinking that he could be a good person to be that gatekeeper to the president. Also, they're really about to get ready for a fight with the Republicans when it comes to the debt ceiling. And under the Obama administration, he was the head of the NEC, the National Economic Council. So they think this is someone that's well prepared for that domestic fight.
Although you do talk a little bit about some of the issues and his board service on Meta, among others. How much does this indicate that the Biden administration is pulling back from some of the discussion about going hard against some of the big tech names?
I'm not sure that people are thinking that because Zients is now the chief of staff that this means that they'll have a different view on tech, right? He left that board because he didn't agree with the direction of where that tech company was going. So potentially some may think that he has a special inside view.
Right.
I think when it comes to this individual, what Republicans probably will most likely say about him as chief of staff was, while many would say that, yes, he was able to get a lot of shots out of the door, you have Dr. Fauci talking about the fact that he was this great management mind in order to take the Biden administration's COVID policy of really making sure that everyone across the nation had access and fair accessibility to shots. There was that stint that there was a lot of pushback from Republicans and Democrats, as well as European leaders, when they didn't open the borders into the U.S. And that was the summer of 2021. It took them to the fall to get up to the allowing more travelers that were vaccinated to come into the U.S.
Anne-Marie, let me cut to the chase. Mr. Zients is a Bainite, a Bainey, whatever you want to call it, out of Boston.
Yes.
And the bottom line is he's got more in common with Mitt Romney than anybody else in Washington. What Senator Warren's going to ask is, wait a minute, is this guy a Democrat of moderate or progressive ilk? And the answer is she's going to say Mr. Zients ought to pay a wealth tax. I mean, is this the guy the Democrats want as the gatekeeper to their Democratic Party president?
Tom, this is exactly what the discussion in Washington is. It's those centrist Democrats are excited to see someone like him take over this role and think he can do a very good job. And then you have those like in the Warren camp that he's just not progressive enough. He has too many ties to the business community. But what you've seen this administration do is 2 years, they really leaned into the progressive side of the party, and you started to see them walk a little bit of that back. Also, as the president is preparing for a potential 2024 run.
Quickly, what's your date calendar this week? What's the appointment, the moment, the party, whatever that matters to Anne-Marie Horton?
I think it has to be tomorrow. The president will be meeting congressional leaders, and that means Speaker McCarthy. And let's see what comes out of that meeting. The president maintains that he will not negotiate on the debt ceiling, and you had all the Republicans out on the Sunday shows saying that's the only way forward.
A complete success. We got through that, Lisa, without talking to Anne-Marie Horton and mentioning classified documents. Anne-Marie Horton, thank you so much from Mr. Zients. We'll do that next time.
Yeah, exactly.
From Washington as well. You know, it's the American way. It's an exhausting process. What I've kept score of personally is exhausted Treasury secretaries, and you see them right after their tenure, and they're just exhausted. Destroyed.
You can see all
destroyed.
of the...
And 90 days later, it's like, wait, is that the same guy?
Well, that's also
and
with
there's
presidents,
a lot of that.
right? I mean, basically they come in and then they age 40 years during their tenure. Yeah. There is this issue with the debt ceiling debate. We remember back in the day when we were talking about it and laughing and, making fun of some people who indicated that some of the things that were happening in the Republican Party might indicate debt ceiling debates.
I'm just saying. Point taken.
But I think that, look, I think that the important thing here is the longer term credibility. Everyone's expecting that there will be some sort of resolution, but the longer they go to the deadline, the more there will be this flare up and this freak out. Does that actually have any longer term consequence, or is it basically just a wash?
To your point, I would suggest that 2011 has scarred all, including those that think this is a non-event, which we heard some of this weekend as well. Okay, I'm going to set this up, and then we're going to do this in the next half hour as well. Ferro is on assignment in London. That is correlated with a small soccer game. As you fly into Heathrow through the fog of the weekend and you look down, on the River Thames is a football field, soccer field out of the movies. Yeah. It's called Fulham. We'll talk to John Ferro about that with Jeremy Stretch in London. Stay with us from London, from New York. This is Bloomberg Surveillance. Good morning. Bloomberg Surveillance. Good morning on a Monday. Lisa Abramowicz in New York, back from Davos. Mr. Ferro in London. We'll go to him here in a moment. I'm Tom Keene. Thank you for joining us on a really interesting week. Before Central Bank Derby, there's an auction derby out there as well, as Lisa mentioned earlier. But I want to take 30 seconds here, or maybe even a little longer. It's deserved. I would think for people that ignore crypto, right now they ignore it at their peril. There's something, we had some conversation conversations on this last week, Lisa, and there's something percolating below even as Bitcoin comes up.
Well, you mean in terms of the genesis and the bankruptcies and the issues that people have where it's a washout. What I thought was interesting is behind the scenes, people who are into stablecoins or some of the other instruments that are a little bit more established and want regulation are kind of hoping for the failure of some of these other companies because they want to just get the washout done so they can move on.
That's the optimist view.
Well, and the optimist's view views crypto less as sort of a speculative tool and more as an instrument to disintermediate the Western unions and the banks for
the heart of the zeitgeist over the weekend. I put this out on Twitter, and I have the clearest memory of sitting with John, and we're watching World Cup, and I'm looking at one of these crypto people promising 8 or 9 or 10% on the web. And the heart of the matter, as I mentioned, this whole thing is structured on what we used to call yield hog. It was real simple. Margie Patel would know this, who we talked to earlier. You can make 7% instead of 4%. Isn't that the whole shtick?
Well, and actually, there were a number of stories of people who put their life savings in some of these accounts because they thought they were high-yielding accounts. There was this one guy who put his mother's savings, and she keeps asking him, where is it? How's it doing? And he keeps lying to her because he doesn't have the heart to say he can't get it out of the exchange. It is painful stuff, especially where it raises this question, well, who's then telling them you can't promise 8%, 9% yield if you don't have what's backing it? You have to put a disclaimer saying you might lose all your money or not be able to take it out.
Even more painful, crypto for Bloomberg on the terminal is under the currency key. Are we still under the illusion BitDog is a currency? I don't think so.
Well, there is this sort of interesting distinction between Bitcoin as a commodity-like speculative instrument and other aspects of the crypto universe as a currency. From a bigger standpoint, there is a question of how do you foster innovation and not cause it? No, I'm serious. In a period of restraint with higher rates and at a time of rampant fraud, when people who are bad actors could go into a world that was really pumped up by low rates and do what they want.
Well, they're going to have to restrain me, get out the surveillance cork. Dollar stronger today. DXY with a 101 level, just barely. Yen 130.22. Japan's sort of quiet here over the weekend. I'd look at Euro sporting as well. Rounded up 1.09. And John Ferro living large with a 124 rounded up on sterling. Ferro looking at, I think, 4,000 square feet over that little cutesy pie metal
4,000 square feet
across the River Thames as well.
Short Austria.
Let's go there. We'll save the soccer chat for later. I mean, John, currency dynamics is led in London by the recovery from 103 to 124.
Two things here, Tom. Number one, I'm funded in US dollars, so I'd rather take 103.50 than 120 plus. Let's clear that up. The second thing, I've got a guess with me. Do you have to do that to me? Fulham. Repeat after me.
Okay,
Fulham. Not
Westham.
Nailed it.
Fulham.
Okay, 2 minutes.
Warwick.
Fulham.
Got it.
Fulham. You're killing me. Euro dollar right now, 108.83, very close to 109. We took out that level a little bit earlier this morning. I'm happy to say here in London I can catch up with Jeremy Stretch, the head of G10 FX strategy at CIBC. Jeremy, great to catch up with you, buddy. Good to see you. Front page of the FT this morning for all to see. Europe can avoid recession. The Eurozone can avoid recession. Can the Eurozone avoid recession?
Well, certainly the mood music has materially changed because of the retreat that we've seen in European gas prices. And, of course, we've also seen that Chinese reopening narrative, which is providing a slightly more constructive backdrop for the German export sector. So the combination of those two factors does suggest that Europe might, and Germany at the leadership of that, might just avoid that negative GDP print. And that's obviously one of the catalysts which has really been driving this euro recovery narrative, alongside the presumption that the ECB is seemingly much more hawkish than the Fed.
It's a relative story, isn't it? Stagnation versus recession. Now we need to talk about stagnation versus expansion and recovery. It's a big difference between the former and the latter.
No, indeed there is. So in a sense, I think what we had is that obviously going through the third quarter last year, we had an enormous degree of negativity priced in or baked into the sort of the Eurozone recovery narrative because, of course, we were talking about the potential for gas rationing. Now, here we are at this stage in the winter period. Now, it is remarkably cold here in London, as we know at the moment. But the actual winter itself has been relatively mild thus far. And if you look at European gas storage levels, they're running around 20% above the sort of levels you would have expected normally at this time of the winter. So that eases the burden in terms of the refilling of those gas storage tanks through the course of this summer. And, of course, we've seen Germany opening its liquefied natural gas ports in terms of Wilhelmshaven, for example. So the ability for Germany to get those LNG capabilities or flows from the US in particular has helped to alleviate some of those recession risks.
Firing up coal as well over in Germany.
Well,
set to do the same here in the UK.
Which is an interesting one. So in a sense, that's one of the legacy issues. So that's why it was fascinating to see, the Greta Thunberg narrative being put alongside at the World Economic Forum in Davos.
You mentioned the ECB. Here's a question for you. 2023, does the ECB hike more than the Fed this year?
Yes, I think it does. I think we're very much in this steady and significant policy narrative. To sort of paraphrase Madame Lagarde and throw Margaret Thatcher into it, the lady's not for turning in terms of the interest rate story from the narrative that we saw from last week. So it seems likely to go along with the comments from Klaas not over the weekend that we're going to see at least 250 basis point moves from the ECB the next two meetings. Do they go beyond that in terms of into the spring? Possibly yes. So that, I think, does suggest that the ECB is going to be a little bit more hawkish than the Fed, because if the market is right, and obviously markets are tending to be very aggressive in terms of calling for a moderation in terms of policy tightening from the Fed, then that does suggest the ECB is going to be more hawkish.
Kit Juice of SocGen this morning, writing in London for SocGen, saying a spoonful of optimism helps the dollar go down. You want to play that against the yen, against the euro? How do you want to play that story?
Well, I think the yen is an obvious and an interesting one, because again we've seen a degree of policy uncertainty really writ large after that adjustment in terms of yield curve control back in December. Now those minutes from that meeting that have been released overnight suggest that a lot of the BOJ members were worried about the communication aspects of that change. But I think it was always going to be the case that, to expect a degree of policy normalisation from the BOJ this year, but more so after Kuroda leaves office, because of course he's only got one more meeting to go. So I think there is still some substantive scope for yen appreciation. So we'd be looking for runs up to maybe 131, 132 in the nearer term to provide better levels to start short, looking for a return back to 120.
The words we use matter. You said normalisation and Japan in the same sentence. So we've had several decades now of zero rates in Japan. What's normal for Japan?
That's true. I mean, I've been in the market for some considerable time, and Japan and Japanese monetary policy has been generally the same. They've been always aiming for this 2% inflation target, which invariably they've missed, other than in sporadic and exceptional circumstances, as we're seeing now. Normalisation, though, I think is a process of moving away from that negative interest rate policy. So I think that's going to be the dynamic that we're going to see. So if we start to see Japan moving away from those negative rates, that has enormous implications for fund flows, because, of course, Japan being that major exporter of capital, exporter of credit in terms of looking for those higher yields, if there is a degree of dislocation in terms of those fund flows and that exiting from Japan, then I think that has enormous implications. So as we look for Treasury JGB spreads to continue to compress, that provides that momentum for dollar yen to move lower.
Talk to me about the limits, about how far the BOJ can go, how far they can pull back from their yield curve control. I was thinking about the ECB in Europe in the last year, and if you told me they were going to deliver what they have delivered, on top of throwing in QT as well, I would have had real doubts about what could or couldn't happen to the bond market. I would have expected the periphery to face a real difficulty. I know spreads are wider, I know yields are out over the last 12 months or so, but not to the extent that I would have said. Have you been surprised by that, and what does that inform you about how far the BOJ might go?
Well, you're absolutely right, because if you think about what we've seen from the ECB, you would have thought that B2B bond spreads would have been pushing 250 basis points or higher and starting to really create some degree of fragmentation risk. So in a sense, I think we have seen a degree of relative calm, if you like, in terms of the movements that we've seen in terms of monetary policy. And I think that's going to be interesting in terms of Japan. So can they tolerate long end yields, 10-year yields moving up beyond 1%? I think they probably can if we get a more normalised yield curve in Japan. So I think there is this scope for an adjustment. I'm not suggesting that the BOJ is going to be suddenly adopting a very aggressive pace of balance sheet constriction. I think it's more about removing or easing those considerations in terms of yield curve control, removing that negative rate dynamic, and then encouraging some of those fund flows to remain onshore. I think that's the sort of the dynamic, rather than necessarily going for a complete sea change, even with the confines of a new administration.
Let's finish on the Fed. The dove's got the last word. Governor Waller, I wouldn't have called him a dove last year, but certainly endorsing the 25 basis point move this year. Are we done after that?
I think we're then getting to a situation where we are literally right at the end game, and I think the data will then determine that. So I think we are still very much focusing on employment and earnings. I think those are the obvious benchmarks. And then, of course, looking within the CPI print to see how things like those rent dynamics play out. So I think we are very, very close to the end game here. But I think the other issue that we would still take issue with from the market perspective is that degree of cuts, that rate cutting that's priced into the market. We're very close to the end of the hiking cycle, but we don't necessarily think we should be pricing in cuts for the second half of this year.
Final question. Markets have to grapple with ever-changing probabilities and price them accordingly. Who's got more chance here? The Federal Reserve getting to 5 or Tottenham getting a top 4 finish this year in the league?
Well, considering my son is a massive Arsenal fan, then I really cannot answer anything in the affirmative in relation to Tottenham.
There we go. Jeremy Stretch of CIBC.
Thanks very much.
Good to see you, mate. Thanks for having us. Tom Keene here in London. That does it for me until I catch up with Ian Steely a little bit later over at JP Morgan. He's going to drop by as well.
An important conversation there, John. And what's really important here, folks, is this is a work assignment for Mr. Ferro. After the surveillance nap, I'll be joining Tottenham Fulham. And John, what I think is really, really important here, and this is something that we don't have in American sports, this is basically my amateur take, the Fenway Park of English football. You're going large, you're living real, you're not in the Johnny Haynes stand, you're going to be in the Hammy stand, H6. What's it like in the Hammy stand of this little ancient 1896 stadium?
I've been to Craven Cottage before, Tom. It's quaint, let's put it that way. It's also pretty difficult for the away team to come and visit there because if you see the condition of the locker rooms where they get changed, not fantastic. Imagine Manchester City coming from up north with their, let's say, multi-million-dollar facilities, Tom, all the way down to Craven Cottage in West London where things are a little bit more old-fashioned and, dare I say, cheaper.
For those of you on radio, out beyond the dome of St. Paul's lies, Fulham. John Ferro with an important bond conversation.
Said it right.
Did I do it okay?
You did great.
That's
Fulham.
okay. Well, Qantas is in my ear. Fulham. It's Perth and Fulham. I'm like, okay,
Not Fulham.
thank you. It's not Fulham. Anyways, futures -6. Stay with us. Bramo is back. Ferro is gone. It's another normal day at surveillance. Dan Ives soon.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In California, authorities say the suspect in the shooting deaths of 10 people in an Asian community near Los Angeles has killed himself. The attack took place in a ballroom during Lunar New Year celebrations. It's believed the suspect, described as an Asian male, tried to carry out a second attack nearby. In the UK, ambulance workers are walking out today in the biggest strike by first responders. Trade unions are protesting pay levels in Britain's National Health Service. They're demanding a double-digit pay hike. Germany and France warn that the European businesses will have to ramp up spending to compete with the U.S. and China. German Chancellor Olaf Scholz and French President Emmanuel Macron met in Paris on Sunday. They discuss how the EU should respond to President Biden's Inflation Reduction Act. The measure includes roughly $500 billion in spending and tax breaks to benefit U.S. companies. Bloomberg's learned that President Biden will name Jeff Zients as his next chief of staff today. Zients is a former business executive who was one of the chief architects of Biden's initial COVID team. He'll replace Ron Klain, who will leave in the coming weeks. The White House chief of staff is among the most powerful figures in Washington. And hedge fund Elliott Investment Management has taken a multi-billion-dollar activist stake in Salesforce. Now, the firm says it looks forward to working constructively with the business software company. Shares of Salesforce have plunged since their peak in 2021. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Tech is really weak compared to everything else, or broadly defined tech. And that's just not something we're used to. The tech is this earnings season, if you take tech out, or tech broadly defined, you have a 5% EPS growth this quarter. I mean, who would think that tech is the thing that's holding everything back? And I think that this continues for longer than we think.
John Golub, just brilliant yesterday. Thank you for the notes on last week's effort. Lisa Abramowicz in Davos, and John and I are holding court on a really, really interesting week, and we're going to try to do that this week going into the Fed meeting that we have February 1. Futures -7, the VIX 20.28. Bonds not giving me much here, 3.50 on the 10-year yield. Lisa and I both noting oil, Brent crude, my eyes are failing me, 88.21. Every time I look, oil's up another couple pennies or two. So there we are. Let's get to it right away. Lisa and I in New York, John Ferro in London, and joining us now, Daniel Ives. He's Senior Equity Research Analyst at Wedbush. We're going to dive right into this, and we're going to talk. There's so many, in a 2-hour conversation with you, we can go 8 ways. We don't have that. 2 things. Apple was a zeitgeist this weekend. They're separate and distinct. And the other's this news on Fortress Benioff. Let me start with Tim Cook. It's going to be a victory conference call for Apple. What will you listen for from the last non-layoff companies standing?
Well, I think, look, they were tacticians in terms of how they built the business, and demand, despite, many yelling fire in a crowded theater, is holding up a lot better than expected. We're not seeing any sort of major cuts. That's going to be a big narrative on that earnings call.
Explain to our audience the McDonald's-ness of Apple. They farm out their manufacturing like McDonald's farms out their hamburger. McDonald's serves hamburgers, Lisa.
Thank you. I appreciate that.
Number 2, the franchise thing. Apple's almost doing a manufacturing franchise thing. So how unique is that within tech? To me, it's a huge distinction.
Well, it's one of their strengths. And it's why Cupertino is unique in terms of how they've built out in China and that supply chain. And I think the thing that, we've talked about more and more control of their ecosystem, chips, they're essentially beating Intel at their own game. And the innovation that's happening in Apple, that gives them ultimately even margin advantage over others. And that's why in others in tech, they're laying off. And Apple, I think, opportunistically continues to add.
So, Salesforce right now, 79,000 people. Benioff is a force unto his own. Here's a fact. CRM down 51% from peak. Market drawdown 50%. Apple market drawdown 24%. What's the damage at Salesforce, and what does Elliott want to do to get it fixed?
Well, I think for Benioff, clock struck midnight. It's not just with Elliott and other ActiveStar board and others. They're going to continue to drive, I think, significant margin improvement. Profits could be potential spin-offs and other strategic changes. And I think it just shows Salesforce, in a very strong position with their install base in cloud. Stock's been, an underperformer of late. And I think our view is that these are festival situations for activists. In terms of what I believe in tech, we're going to see more and more activists, especially in this market.
So Salesforce shares in pre-market trading up 4.4% after this announcement that Elliott had made this multi-billion-dollar investment in Salesforce. What other companies are good targets for this festival that you describe for activist investors?
Well, I think you're going to see it across the board in software and in chips. I think those are really the 2 areas that you're going to see activists really spend a lot of their time, not just because of the margin situation, but also this is the time where you're seeing tech firms cutting across the board, obviously despite what we're seeing with Apple. And I think that's really creating now in terms of M&A, growth opportunities, potentially drive more buybacks, dividends, especially in an underinvested tech landscape. I believe it's as underinvested as we've seen since 2009, which I believe the earnings setup is bullish over the next few weeks.
What are you pointing to when you say that? Because some people say that's actually not true and that people are still heavily invested in big tech. They haven't given up the bet. What are you looking at statistically to say that they're actually still underinvested?
Yeah, I can tell you, talking to institutional investors 22 years, this feels more like 2009, 2002, relative to sentiment. I think how many are invested going into earnings. And I believe right now, New York City cab drivers bearish on tech.
I looked in at the dividend growth of Apple to bring it back to the Cook Victory Lap and the Cook Victory Conference call. I don't understand. I get the whole share repurchase thing as well. It's almost like they don't want to be a Dow successful blue chip stock. Dividend growth over the last 10 years from 11 cents per share, and in many fewer shares, I believe they're up to 23 cents right now. Do they shock the landscape by popping an institutionally appropriate dividend?
Well, I think for Cook and Cupertino, that's always been the conundrum because it sends the signal in terms of growth. They don't want to be known as right lane going 45 miles an hour because this is actually a company going 70.
A 1% yield is right lane going 45 miles an hour?
Well, I think for them right now, they're going to try to find that sort of balance in terms of dividends and buyback because, this is a company that continues to generate just massive, massive cash flow. And I think it's that balance. But they are going to continue to innovate and grow in some of these huge growth areas.
So who are they going to cannibalize from? You mentioned Intel and how they're beating Intel at their own game. We get Intel earnings on Thursday. How much are we going to see Apple really hurt chip makers by making their own and circumventing them entirely?
The scariest thing to the chip sector is Cook and Cupertino, because they're essentially, you're talking about one of the bigger buyer chips, and now they're going to really own more and more of that landscape. They want more control of their ecosystem, and I think you're going to see that more and more, not just on the chip side, but even in AI and some other areas. And I think that's a theme that we're going to see with Apple, because as Tom talks about this period of time, they're going to get stronger, Apple.
You've been very vocal about the haves and the have-nots within big tech, and you're giving a pretty rosy picture. The underinvestment in the Apples of the world, perhaps in the Salesforces of the world if activist investors get involved. What about Facebook? What about Meta? What about some of the others that have perhaps a bit more of a challenge in a different way?
And I think there you'll continue to see from Zuckerberg continue pivot further and further away from metaverse. I mean, obviously that's a long-term strategy, but
keep a straight face.
Will it be renamed Facebook?
I mean, look, because realistically, they're going to realize more, and you see why that stock's up significantly since those cuts. They got to double down on social media. It's an arms race there in terms of digital advertising, what's happening. And that metaverse strategy, which seemed so good 12, 18 months ago, name change was awesome, PR move. I think more and more realizing that was not the right move.
What's Valentine's Day look like for Mr. Musk? What's his February look like? I mean, there's so many moving parts here. You're expert on the Tesla thing. Twitter's a private company. But Dan Ives on how Elon Musk gets to, I don't know if is it a leap year this year? How does he get to February 28?
Well, I think first it's a CEO of Twitter. I think that's really important, further distancing himself.
Are you shortlisted?
Look, in my opinion, I believe, you know, even though
he's not.
Even though
just like Ferro.
Even though that's something. No, but seriously, I think he has to name a CEO of Twitter. You got to rip the Band-Aid off this week in terms of deliveries, in terms of what I believe is probably 35, 40%. And then I think third is just really showing that demand story is going to be strong.
Just real quick here, when are layoffs not going to be a great thing for the shares of these tech companies? Because that's what we've seen pretty universally.
Yeah, I think we still see another 5 to 10%. If we get into the middle of the year and there's more and more cuts, that's where it gets darker. But right now, it's an excuse for these companies to cut after spending like 1980 as rock stars.
John from England emails in and says, Sterling's 124. Ask Dan what his price target is on Apple. Ferro's got to make some money here.
Yeah, so 175 base, 200 bull case, and I just believe this is one where many yell and fire in a crowd theater, but Apple's going to be a rock of Gibraltar in this earnings season.
So you got a bull case there, 137 to 200?
Yeah, and I believe right now, you start to do some of the parts. I believe the services...
What's some of the parts? Come on.
Some of the parts services business, you could rationalize the services business conservatively 1.4, 1.5 trillion. And you start to sort of... You look at that hardware business and where we're going to go into an iPhone 15 cycle, I think there's a stock closer to $200.
Come on, what's the share price on that? I can't read 8 pages of Ives. What's the sum of the parts share price?
So share price right now, you have what I view as $70 to $80 right now per share is the services business.
And so if you're getting everything else on your 200 for like 100.
I believe you look at iPhone hardware business significantly being underestimated in this multiple compression market.
You don't see this on radio. Lisa, my clothing consultant, just emailed in and said, "Can you get the Ives look down?"
You know, honestly, I just well, yeah, we're going to work on that later. But I do want to just say, you're the one who compared Apple to McDonald's. If you go to an Apple store, there are people lined up, can't get people to check out quickly enough to buy $1,000, $2,000 of merchandise.
No,
so this really speaks to what Dan is talking about.
The way they've taken their process risk and distribution risk off their income statement is brilliant. I mean, this goes back to Larry Haverty and the rest of them. Dan Ives, thanks so much. Don't be a stranger.
Thank you.
Thank you.
Very visible. I hope those are good questions to inform you on technology or into a Monday. As well. Futures -7. We're looking at the bond market. So is John Ferro in London. An important conversation coming up on fixed income in London. Alifa Dorwala with us as well. Rock Creek. Stay with us. This is Bloomberg. Good morning.
We have a Fed here who's not backing down.
What is the market saying? I don't believe you. It's pricing in rate cuts. It's already seeing the data roll over.
The way they're feeling now is comfortable that they've maybe done enough or getting close to having done enough.
At some point, you have to move to 25 because you've done a lot. You don't know how much damage that you've done.
Expectations for the remainder of the year for 2023 are quite bleak. Earnings are supposed to go down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro in London, Lisa Abramowicz back from Happy Valley. I'm Tom Keene with Lisa in New York. We welcome all of you on radio, on television, an eventful 5-day work week. Everybody on board this week into the Fed week next week. And Lisa, it's real simple here as we churn here with economic data, GDP coming out later. First look at Q4. It's all about driving to February 1.
How much do we get from the Fed, this feeling of that step down that they're talking about? Does it
The
really
Waller
matter?
effect.
But this is really the issue to me is, does it matter? Does it basically just mean that they're building an insurance by going slower, but they're going to get to the same place and hold it there for just as long? And that, to me, is the distinction that is really being debated in markets.
You know, you were in the Gulfstream in the Zurich runway there on Friday. We were talking to Andrew Hollenhorst. Hollenhorst was on fire with Citigroup. We're there. He said, yeah, we've gone 50 to 25, but he did not give up on the migration to some form of 5-ish terminal rate.
And he's not alone. A lot of people saying the same thing from the analytical community, but the market's basically rejecting that and still pricing in rate cuts. At this point, how much are we ignoring the inflationary impact of China reopening? How much are we ignoring the inflationary impact of a Europe reignited by a warmer winter and people able to go out and spend, and different aspects of the inflationary picture continuing to accelerate? These are some of the issues people are worried about, and the head of the Norwegian Sovereign Wealth Fund basically said we could see inflation reaccelerate, and that would be a worst-case scenario for all assets.
Okay, that's the gloom, but that's around hydrocarbons. And thank you, Will Kennedy from London, for I think that's Farrow's over. They were partying last night. I think Will Kennedy and Farrow.
Is it a new LME week?
Yeah, it's an element. When John's in London, it's always LME week.
Yeah,
we know that. 88.40. Just as the beginning of this show, we're about ready to round up Brent crude to $89 a barrel, and that folds into that inflation lift the gloom crew's talking about.
Everyone said that there would be more demand coming from China as they come back online. The Lunar New Year is being celebrated this week, so it's quiet over there. But after you start to reopen, after that, you might get a real sense of that. At what point, then, has this been a story about energy and energy prices that went down, and all of a sudden disinflation was the story?
Right.
And now if prices go back up, people have to start thinking about what happens if that really is the
We
issue.
have to see, and of course, the school of thought on China opening and demand large, that we will get some form of lift here above $100 a barrel. We're halfway there, I'd say, off of the disinflationary joy that we saw a number of weeks ago. We get a really nice synthesis coming up here on EM and global economy, but I think we really got to go through the data now. Futures give me nothing this morning, -3, right on the screen throughout. VIX giving me nothing, 20.22. Yields lower. We are on the low yield watch. That turned around abruptly. I think it was Thursday. 3.50 on the 10-year yield. A little bit of less inversion, but I do want to point out 10-year real yield, inflation-adjusted yield, my benchmark still quiescent at 1.25. And Lisa, just to close it out, the Bloomberg Financial Conditions Index is back up to an accommodative positive 0.20.
Yeah.
The number doesn't mean anything, except that Jerome Powell says it's a job not done. Major thing.
The issue that I have is people have stopped talking about this. The financial conditions aspect, they're saying, they're just looking at the real data and they're going to be patient. This is a tension. How much do they talk next week about the financial conditions and the easing there and what that means for their inability to transmit financial policy through that? Here's what we're looking at this week, because today is a pretty quiet week in this quiet period ahead of the Fed meeting next week. Treasury auctions. We've got the 2-year note tomorrow. We've got the 5-year notes on Wednesday, and we've got the 7-year notes on Thursday. Watching the 5-year, the belly of the curve, where a lot of people were investing, how much do you start to see people move back from this belief that the Fed will go enough to stymie inflation in the longer term? How much do you start to see people bake in the expectation that inflation will remain higher for longer? This week, a slew of earnings. We got Microsoft on Tuesday, Tesla on Wednesday, and Intel on Thursday. I'm especially interested to hear what's going on with the chip makers, especially in light of what Dan Ives was just talking about Apple kind of cannibalizing the business away from the Intels of the world at a time when they've they've got a glut of chips. Very curious also from Microsoft about Azure, the cloud computing system and the investment there, how much companies are going back to those tech investments. And Friday, we get a slew of data after getting the GDP print for 4Q, after we get a host of other data, durable goods. We get personal income and spending. And core PCE, the key metric that the Fed looks at, it has been rolling over just a touch. Does it turn the other way? And does it flatline? How much does this give a sense of where we are in the base looks that people look at to get a sense of inflation?
Yeah. Headline right now out on the Bloomberg. I want to underplay this. This is Spotify of music streaming. They've got some real competition from Apple Music in the wonderful title, Spotify to cut about 6% of a 7,000 workforce. Not a big deal, but at the margin, they're sort of a tea leaf for the morning.
Well, just the layoffs continue and the shares rally. I mean, to me, that's you
mentioned that, Mr.
The
Rice.
shares are up more than 3% now ahead of the market. That's what you see. These tech companies announce layoffs, their shares rip.
Friday, as we were resetting for the weekend, we really decided to look at asset allocation. And we continue that theme this morning with some good other stuff coming up. John Ferro in London on fixed income strategy here in a bit. But right now, Alifia Dorwala joins us with Rock Creek Group. They are an exceptionally thoughtful group with real hydrocarbon focus and also with an EM bent. We're thrilled she could join us this morning. Alifia, what is cash right now? Is cash an asset?
You know, last year, cash was definitely an asset. We were overweight cash and it helped our portfolios. This year, we are starting to put a little bit of money to work incrementally within fixed income more than anything else. A little bit too early to be really chasing fixed income, but we think that at some point, we're going to want to start extending duration. So fixed income is a big focus today.
What do you do with energy as the only survivor of an ugly 2022? You people have got terrific natural gas history. How do you frame that, or how do you bet on that out 3 years?
Yeah, and you know, Lisa, you mentioned two of our main themes. Will the energy shock from the war in Europe continue to be contained, or do we see part two this year? You know, we saw winter warmth, we've seen European subsidies, we've seen the U.S. tapping into the Strategic Petroleum Reserve support, containment, and then we see China, on the other hand, you know, demand for oil is going to increase as China reopens. And so we're kind of looking at all of these factors and saying, is the second half of the year going to be a little bit like we were seeing some of the tensions in the last year?
So let's put those two ideas together. You were saying it's not time to lean into duration, but you're waiting to, and the potential for the energy crisis to rear its head. What are you waiting for? We've seen a rally already. So yields are already almost a percentage point off the recent highs for the 10-year. What are you waiting for to say it is time?
Yeah, and it's a continuous conversation as markets are moving, but we've seen a disconnect, right, between market expectations and the Fed's hawkish announcements. The 10-year seems to be stuck a little bit around 3.5% because markets think that the Fed's going to have to pivot and reduce rates. We think that the 10-year could retrace to around 4% at some point early this year, and then that's going to signal a good opportunity to slowly start buying duration. Again, we're looking for good entry points to start extending duration in our fixed income portfolios, but we don't want to chase anything because we do think that we're still a long way off from the Fed really signaling any sort of even pause.
What's interesting to me is the idea of a 4% 10-year yield and the implication for equities that previously sold off when yields went up. But if we have an environment where it's a positive look at the economy, at what could potentially happen with growth, is it also going to be positive for equities in the short run?
You know, I think equities are going to be maybe potentially a tale of two halves this year. You know, we think kind of middling for the next 6 months, but I think you're going to have to pick your spots. You have to remember the S&P is still trading around 18 times, whereas Europe's trading around 12.5, and EM in certain countries even lower. So it could be a valuation story the first half of the year.
Alifia, with you and Afsani, let's just talk about the Vogue again. I believe it was a Vogue 12 months ago, 24 months ago, 36 months ago. You get the theme. EM and international are back. Is this time different?
You know, it feels like a little bit of a consensus trade because you're starting to hear people really talk about it more. And again, you can't generalize EM. I mean, China to Brazil to India, these are completely different factors, completely different time horizons you have to have. But as an institutional investor, you have to be in emerging markets. And to some extent, you have to get China right, because that is still the biggest determinant in an EM portfolio.
Alifia, thank you so much. Alifia Dorwala with Rock Creek Group there on the allocation mystery here. We really tried to cover that here in January as we move forward. As John says, market outlooks ought to be done March 31 after everybody gets the year set up. Doug Cass with a really important insight. Thanks for listening and watching down in Florida, Mr. Cass. He's with Seabreeze with real money at risk. And when we talk about share buybacks, and Doug Cass, Dan Ives is really good at this. Lisa, there's two kind of buybacks. You buy back shares and your share count goes down. Think Intel 15 years ago, think Apple now. And then there's you're buying back shares and you look brilliant, but it's a complete shell game because you're issuing shares out for compensation. And it's a wash. Mr. Cass mentions this with Amazon and the like. I think that's a really important technical point that's often missed.
Well, there's a bigger point behind that, which is people look often to the share buybacks as a tailwind to a lot of companies and a lot of their performance. And there isn't as much share buybacks that are planned this year. So what kind of pressure is that for equity performance at a time when shares are lower and that won't necessarily be the counterbalance? And that's something people are analyzing.
There was a great study done a million years ago. I'm going to pick on Textron, which is a name from the past. I'm not sure that was the company, but we'll say so because it's a Monday. And basically they did a study at Textron, and basically companies buy back their shares at the top of the market.
Yeah, well, that's exactly what happened.
And they say, no, we don't want to do that at the bottom of the market. That's they're no brighter than I am. They should be in the triple leverage share buyback program.
They're in the triple leverage Austrian bond program, I hear. It's a really successful
You were not there for that. That was painful. I mean, some of these bonds, I mentioned, I don't like to mention bond names on air, but in the old days where Pim Fox and I would get out the Blue Book and look at the Standard & Poor's Blue Book, I mean, a given investment-grade bond is down 10, 15, even 20%.
It's going to take a while to get that back, right? And so have we reset to a normal that's going to be sustainable that can actually compensate for all those losses?
Working right now and getting up the Fulham countdown clock here to the Fulham Tots game. Ferro will be in attendance.
You're back to that?
He's in London. I'm sorry, brain freeze. Excuse me there. Ian Steely will join Mr. Ferro. He is with JP Morgan in London. Look for that here in a bit. Futures at -4. Dow futures -4. How can that be? SPX Dow, same futures. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Poland will ask Germany permission to send its German-made Leopard tanks to Ukraine. On Sunday, Germany's foreign minister said if Berlin were asked about the tanks, it wouldn't stand in the way. The failure to work out an agreement on tanks has overshadowed pledges to send more military aid to Ukraine. In California, authorities are trying to figure out the motive for a mass shooting in an Asian community near Los Angeles. 10 people were killed when a gunman opened fire in a ballroom during Lunar New Year celebrations. The suspect, described as an Asian male, was found dead of a self-inflicted gunshot wound. The Justice Department has found more documents containing classified information at President Biden's home in Delaware. FBI agents searched the home for more than 12 hours. They are said to have found classified notes from the president's time in the Senate and vice presidency. In the UK, the power grid is asking some households to cut energy use today, and it's likely to extend the request to Tuesday. A plunge in wind power and freezing temperatures are testing power producers' ability to keep the lights on. And Spotify is the latest tech company to cut jobs. The streaming giant said today it is cutting its employee base by about 6%. The company has about 9,800 employees. Spotify's stock fell 66% last year as investors questioned when they'd see returns from big investments in podcasting. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We should have a clean lift of the debt ceiling because the 14th Amendment to the Constitution says nobody should question the creditworthiness of the United States. I don't think anyone should flirt with not paying the U.S.'s credit card, which is what Republicans are doing. We should raise the debt ceiling. But if Republicans are saying they won't do it and they're threatening our creditworthiness because they want cuts, let them put cuts on the table.
One of my favorite people on the planet, Timothy Keene, understands that if you are at the University of Richmond, you get to go to the ring dance, which is a holdover from another time and place. He is the former mayor of Richmond. He taught at University of Richmond Law School and worked his way along the path to a vice presidential candidate with Secretary of State Clinton, and then on to his work in the Senate himself. He's part of the matrix that's out there. John Ferro in moments from London on Fixed Income, Lisa Abramowicz and Tom Keene in New York on radio, on television. And we go to Anne-Marie Horton, Bloomberg Washington correspondent, to speak of Senator Keene and the idea that's percolating, Anne-Marie, of governors as presidents. Civics 101, do governors make good presidents?
I think some might agree. I guess it depends who you ask. They have their own little fiefdoms and domains, right? So they're almost the president of their own state, so they go through the motions. I think at this point in Congress, things are so volatile, which is why you see both parties potentially looking to governors to be their leaders in the 2024 election, especially on the Republican side.
Greg Valliere with Bloomberg earlier this morning, in his very early morning, really emphasizes this today, and it can be the governor of Michigan, Democrat, it can be the governor of Florida, Republican as well, but they're percolating up. Are they advantaged in terms of getting ready for the primaries because they're distant and removed from the Capitol Hill Derby?
I definitely think so, especially when you just see the fact that there's just nonstop political debates, even on things like, obviously, the debt ceiling, which has been the central debate on Capitol Hill between Republicans in the White House, Republicans and Democrats, what they're going to do about it. And does this really even resonate with the American people that are worried about everyday things like higher grocery costs or higher rent? And we spoke to Governor Sununu of New Hampshire last week, and he was pretty direct when he said, God, no, I'm so happy I'm not in Congress. And he thinks he can get a lot more done outside of Congress. And it does set individuals like him up for a better run in terms of especially the PR when you want to pitch yourself to the American people.
And Lisa, percolating over the weekend, boiler up, that would be Mr. Daniels of Indiana percolating as well. Mr. Trump, I guess, pushing against that a little bit as well.
The subtext of a lot of what you're asking Anne-Marie about is, will President Joe Biden run again? How much pressure is there?
I forgot to mention that
How
small
much pressure?
matter.
I mean, that's basically what we're talking about here.
Farrell went to London and you're replacing him,
No, but
giving me grief?
what's the pressure here? And how much is it really ramping up from other Democrats against President Biden, saying, stop it already? You're not popular, especially with the classified documents, which we didn't mention last hour, but we'll mention this hour. Let's start setting people up to run instead of you.
Listen, the classified documents and the drip of them, and over the weekend we have another one, an FBI search, more than 12 hours, a fourth batch discovered. All of this is going to make it a lot more politically embarrassing and harder for the current president as he wants to potentially talk about a 2024 campaign and run. On the other hand, this president did get a lot done in his first 2 years as president, right? And at the same time, there was supposed to be this massive red wave referendum on President Biden in November, and there was not. So he is in a position now where many in the party do feel like if he wants it, he has proved himself. But again, yes, there still, of course, are those whispers about it is time for a younger generation to take the lead.
Biden should be embarrassed by the situation. The words yesterday of Senate Majority Whip Dick Durbin talking about what's going on with the classified documents. There does seem to be a lot more pressure. I understand some of the wins. I understand some of the arguments on the other side. If former President Trump doesn't run, is it likely that President Biden will also step down from the race?
Well, it's an interesting question because if you look at one of the latest polls from Suffolk County, USA Today, it shows that Biden would still beat Trump, but that, say, a Governor DeSantis entered the race, he would be the one that could beat Biden. So potentially, if Trump was to bow out, the current president maybe would also look to the Democratic bench, which at this moment looks kind of slim. But the president also has to be careful about the timing of all of this. He will become a lame duck president the moment he says he does not want to continue to a 2024 race.
I look, Anne-Marie, at the setup for the week and the politics that's folding out. Help us with the calendar into the year. When does the primary season start? And by that, I mean, when do the centrists from both parties confront the very hard left and very hard right wings of their party? Is that autumn? Is that summer? When is it?
Well, I think it's already started. We heard from Nikki Haley on Fox News talking about the fact that she hinted about her own run and wanting to get involved in the Republican primary. There's really no reason why anyone should come out too soon. Right now, we only have one individual that says he is running for 2024, and that's former President Donald Trump. So a lot of people want to see who decides to get in the race and if they are going to want to go up against them. One of the more key parts is who, once you're in it, when do you back out? The timing of backing out and making sure that you are part of potentially a future candidate and giving that individual the help and the leadway and the campaign financing that they would need. But I would say by the summer, you'll have a lot more names percolating around Washington.
Anne-Marie, just real quick here, which party gets hurt the most by the debt debate, the debt ceiling limit, and all of the drama around that?
After the debt ceiling.
Well, yeah, it's
well,
interesting.
if you look at past polls, it is Republicans who have fared the worst when it comes to the debt ceiling. And this goes back decades because they continuously bring up this fight saying that they want to negotiate spending on it. When you saw during the Trump administration, Democrats went on with the debt ceiling. The Republicans had to raise it. The former President Trump was in power, and they voted for it. So when you look at past polling of the American people, it's the Republicans that it actually hurts more.
Anne-Marie Horton, thank you so much in Washington this morning. We'll continue on that. Right now, Ian Lingen publishing moments ago, and he says this is not 2011. Treasury dynamics will be very different off the shock of any kind of rate decrease, a rating decrease, I should say.
And there also is the lessons learned from previous eras. And, you know, we were just hearing about.
I do agree with that.
And just what Anne-Marie was talking about, the sort of political liability of being on the wrong side of this debate. Even former President Trump was out saying, please don't do this. Don't be an obstacle to passing this. He was talking to fellow Republicans. This is really an interesting moment as we end up with something that could be dramatic, but people aren't necessarily pricing in yet.
Well, we'll have to see. I mean, it's to me, I'm still waiting to get out to summer. And as we heard from one Democrat, I'll be honest, I can't remember who it was. Maybe it was Senator Keene. Can they just show us their spending cuts? Which is what they don't want to show. I mean, they don't want to play that card, to say the least.
Yeah, well, it's not very popular for Social Security payments to be cut off, and that seems to be a big concern.
Would that happen if there's some form of shutdown? Is that like?
I will just throw out that it has to become an issue. If banks don't understand where the funding's going to come from, will they actually process payments? There are things like that go on behind the scenes.
This is like hot stove league. It's a hot stove league debt ceiling topic, like the Red Sox. It's just painful.
It is painful. I will say that.
Painful. Also, the Bitcoin. I sold it all at 15,000. 23,000 on BitDog.
When did you get so interested in Bitcoin?
Matt Miller grew a beard. I said, that's it. I'm gonna,
You're going to be all in on Bitcoin?
All in on Bitcoin.
I mean, where did this come from?
Futures at -3 if you're brave. The VIX 20.18. 10-year yield. John from London emails in and says, it's cold here. Quote bonds more. 2-year yield, 4.18%. Stay with us from New York, from London. This is Bloomberg. Bloomberg surveillance. Good morning on a Monday. Bramwell back. She says bonds. We'll be looking at bonds here
anything else.
Through the hour. Let's do a Ferro-like bonds data check. We'll do that 4.18% on the 2-year. Well, we're sort of down towards 3.99. Didn't get there. Reverse back a little bit higher yield, up a basis point. This morning, 3.50%. Of course, the 2-year and the former benchmark piece, somewhat related into a 30-year mortgage, 3.68%. We're watching Brent crude seriously, 88.27. It gets our attention. Ferro in London with an important bonds interview. We're going to do one here in a moment. Lisa, I want to go to you. How about that housing market?
Yeah, well, that's been a serious question. How much more pain is there? And honestly, when I was speaking with people last week, they were saying there could be another 10% decline.
Come on. This is what drives me nuts about Davos. The people you're talking to can't decide on a weekend whether to take the helicopter to their 4th or their 5th home. I should listen to them about housing?
I take your point. There is a feeling of how close are you to the reality of anything that normal people deal with at sort of a highfalutin kind of affair like this. That said, when people look at the granular data, there has to be some retracement with mortgage rates where they are. And that was definitely a theme that we heard pretty persistently, not only from executives, but also academics and others who study the market.
What did you learn, I'm going to guess, off-piste, as they say, when you're off the deck of the famed Davos view of Bloomberg? What did you learn about the Schwartzman-Blackstone real estate experiment, as they call it?
So basically, if you end up as an institutional investor owning large swaths of single-family homes and renting it out, what do you do? Honestly, I don't have intel in terms of whether they're going to keep buying or whether they're going to sell. But what you are seeing in the data is that rents are continuing to climb because people are priced out of buying those homes because of the mortgages.
Do you think that's a tangible factor?
I do. I think that, because honestly, if you look back historically, rents don't go down that easily. It usually they stay the same and people have to be housed.
We're as guilty of this as anyone. John Miller owns a high ground on this, and once again, a luxury apartment study this weekend of stuff nobody could I couldn't even afford the tax payment, let alone the property.
Yeah,
I just wish John Miller, with all of his wisdom, would actually go to like Queens, 47 blocks around 6 Greek restaurants. We'd probably learn more from that than anything else.
Well, there's a huge bifurcation, and we see this ongoing, and this is why it's so hard to get a handle of the data between the lower end, the middle end, and then the high end, which seems to be insulated from a lot of the pain. And we continue to see that, whether it's the housing market or beyond.
Do we have equity love
we
today?
Do.
What are we doing with the
Spotify? Let's start with Spotify because they announced. Well, we talked about how they cut, or they're announcing layoffs of about 6% of their jobs, and what I find interesting is the shares are popping. They're up almost 5% ahead of the market. To me, how long does this go on? Where if big tech companies or even medium-sized tech companies announce layoffs, their shares rally. And we just heard from Dan Ives, it's probably going to happen until the middle of the year, and then people might end up getting a little bit more concerned about more pain.
Can I just, with Spotify, and what do I know about this? 4 years, 5-year track record, they're negative 40% per year total return. I mean, is this a viable business? Are they a zombie company happen to be trading public, I guess is what I'm asking.
And I'm not going to answer that, but I will frame this in another way, which is how do you identify the tech companies that have staying power, the Apples of the world? How much are we looking at a sea change in the business of, say, podcasting, which Spotify was massively invested in? So we do have that. Also, I wanted to take a look at Salesforce because the Mark Benioff empire, as you were talking about, you do see Elliott Management coming in, the reports that they had made a multi-billion-dollar investment. I find it fascinating, this point that Dan Ives also is making about how it's going to be a festival for activist investors, and those shares also are up about 5%. Basically, they're going to make the cuts necessary, make the management changes, do the spin-offs to get some action back to the shares and some value. Tesla reports earnings on Wednesday, and those shares are up about 2.2%. They announced cuts, and you talked about them on Friday, cuts to the pricing.
Yeah, very interesting, actually. There's been some very good reading on that.
But why? Is it because of a lack of demand, or is it because they're trying to basically price out their competitors and get ahead of the GMs and the Fords of the world?
They're exactly right. And what they're doing here, when revenues are price plus units, cut the price, units go up, and revenues do better than you would think with a 20% price cut.
So how much does that really give a feeling ahead of the following week when we get the GMs and the Fords of the world reporting earnings? Do we get a sense of what the demand is like from those earnings results?
We will see. And again, the 10-year yield 3.50%. In the crosshairs of the retail damage in fixed income, truly an historic year, is the Charles Schwab Company of San Francisco. From the Schwab Center for Financial Services, Colin Martin joins us right now, their fixed income research acts. Colin, I'm going to cut to the chase. It drives me nuts in financial media where fixed income sophisticates talk about spread, they talk about dynamics, they talk about as if 2022 didn't exist. I looked at one blended iconic bond portfolio down about 17%. I looked at an individual piece, which I'm just going to mention. The 30-year Microsoft piece is down 30% from its price peak at 110 as well. Let's begin with a look back. How bad is the carnage?
Well, Tom, it was a really bad year in 2022. And what we tell our clients at Schwab is, unfortunately, we can't undo that. How we do like to frame it, though, is making sure that you're really matching the investments you own with what your time horizon is. So I'm going to use that Microsoft example you just gave us, because a lot of times in the financial media, we hear people sort of sensationalize things with like the 30-year treasury and, you know, the carnage we witnessed there. But the way we look at it, Tom, a lot of our clients and a lot of individual investors aren't owning 30-year treasuries or 30-year Microsoft bonds. Maybe they have a liability in 30 years, but we don't think a lot of our clients, a lot of individual investors own those. So we really focus more on the intermediate side of the equation. But I think another way to frame it is what I said before, is matching that time horizon. If you buy a bond and you're holding it to maturity, these prices are unrealized. You know, these are not actual. They're paper losses, they're not realized losses, and you know what to expect at a given time frame. Now, the same is not true for funds, of course, and that's a whole different story. But we can't undo what we saw last year. It's been a strong start to 2023. We don't expect this pace to continue, of course, but we still think the outlook is favorable now. But again, you just need to align your investments with your time frame and objectives.
And what's so important there, folks, is Mr. Martin absolutely nails where people like me go out to the sensationalism of a 30-year, or dare say a 97-year Austrian piece to get a big number to make a banner pop on television, or even a banner to pop on radio. With that said, what is the duration that you have? The duration of U.S. paper is 5, 6, 7 years. Do you come inside that within most portfolios?
No, we think that's okay, Tom. And actually, if you're looking for good examples, instead of a 30 or 50-year, you can go to those European 100-year bonds. That's going to give you, better bang for your buck. But in terms of what we're telling our clients, five duration or even a little bit more would be okay with us. The way we frame it is to not just be short right now. I know that's a concern, especially given last year's performance, but we think there's this idea and hesitancy to move further out in the curve because of the inverted yield curve, right? A common question is, why would I invest in a 10-year bond at 3.5% if I can get more in a money market fund or a 6-month T-bill? And we'd rather lock in those yields with certainty. So what that magic number is, we don't really have one. It's going to depend on each individual investor, but we think it's probably a little bit longer than what most individual investors have right now.
Colin, don't you get a little concerned or feel uneasy given the rally we've already seen, how much yields have come down? This concern that maybe the trade's already up?
It is a concern, Lisa. When we published our 2023 outlook, we thought the 10-year could fall to the 3 to 3.25% range, and we got awfully close to there in just a couple of days. Our guidance is a little bit more difficult now, and we understand it is a difficult pill to swallow to accept a yield at 3.5% when it was just 4.25% for the 10-year, back in October. So it is a little bit more challenging. But our outlook really does remain the same, because we do think growth should continue to slow. We think what we've seen in the soft data should translate to a softening in the hard data. We think inflation is going to continue to trend lower. And we think as time progresses, we will see those Fed rate cuts. And that's really what it comes down to, because if you look at intermediate and long-term yields, markets are forward-looking and they're seeing, well, what's the average of that short-term rate over X period of time? Now, we don't know if those rate cuts are going to come in 2023. We think it could be a 2024 issue. But we do think that as growth continues to slow, we will see yields kind of across the curve, especially on the short end, fall a little bit. That's a second half 2023 and early 2024 issue, though.
Colin, when do you think that inflation will fall to 2%, the Fed's goal?
It could be later this year. It's probably a 2024 thing. One thing that we look at a lot is wages. Yes, they're coming down, but they're still at an elevated level. And I think that we know is a key driver of inflation. And when we just look at the broad labor market landscape, it's still relatively strong. We're still trying to figure out how we marry the two issues of the headlines we see of all these job cuts and hiring freeze announcements with a still low unemployment rate. But given that hard data we see, we think the labor market's remaining resilient. We're also looking at these monthly numbers. So I think the PCE report this week is going to be important. We're still at that, 2.5%, 3.5% level if you look at those monthly numbers. So we're still looking at 2s and 3s, 0.2%, 0.3%. We need to see 0.1 and 0.2s before we're more comfortable that we're going to get to that 2% level.
Colin, really thoughtful. Thank you so much. Mr. Martin is a Schwab Center for Financial Research as well. What he said there, Lisa, I really can't say enough about it, which is if you've got something moderate duration, you're in carnage down 15%, down 10%, you're scared stiff, you just hold the puppy back to maturity. The iconic book on this is Inside the Yield Book, Sidney Homer and Marty Leibowitz. I was directly involved in bringing back the second edition of it. It is a rite of passage in bonds. You have to read it. And the major message, which you heard from Colin Martin, is don't panic and hold it to maturity.
Well, and just to extrapolate that out, this was one big discussion, and it has been in the private markets, where if you basically just don't price in the pain, does it go away? Because everything will back to where it was and the value that it used to have. You've got regulators, you've got central bankers saying, no way, this is going to be an area of pain. And you have people in the market basically saying, this is why it's good not to have daily pricing.
I don't know if I'm more depressed. 50 years on from Inside the Yield Book, the majesty of Sidney Homer and Martin Leibowitz, or, what Fulham's going to do. Fulham? Which is it?
It's the one that doesn't indicate what we're going to have for dinner.
Okay, it's going to be one of those as well. Stay with us. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In California, authorities say the suspect in the shooting deaths of 10 people in an Asian community near Los Angeles has killed himself. The attack took place in a ballroom during Lunar New Year celebrations. Now, it's believed the suspect, described it as Asian male, tried to carry out a second attack nearby. In the UK, ambulance workers are walking out today in the biggest strike by first responders. Trade unions are protesting pay levels in Britain's National Health Service. They're demanding a double-digit pay hike. Germany and France warn that European businesses will have to ramp up spending to compete with the U.S. and China. German Chancellor Olaf Scholz and French President Emmanuel Macron met in Paris on Sunday. They discussed how the EU should respond to President Biden's Inflation Reduction Act. That measure includes roughly $500 billion in spending and tax breaks to benefit U.S. companies. Bloomberg's learned that President Biden will name Jeff Zients as his next chief of staff today. Zients is a former business executive who was one of the chief architects of Biden's initial COVID team. He'll replace Ron Klain, who will leave in the coming weeks. The White House chief of staff is among the most powerful figures in Washington. And Spotify is expected to be the next tech company to announce layoffs. Bloomberg's learned that the music streaming giant is planning layoffs as soon as this week. Spotify's stock fell 66% this year as investors question when they'd see returns from big investments in podcasting. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
There's enough softer price and wage data for this Fed to, I think the way they're feeling now is comfortable that they've maybe done enough or getting close to having done enough. I am quite uncomfortable that they've actually done enough here, and I think we're going to see that in some of the upcoming data.
Andrew Hollenhorst, Citigroup, with really an eventful week on Bloomberg Surveillance. We thank them for making available their lead economist. And I really can't say enough about that conversation. I got many, many notes off of the intelligence of the kid from UCLA. Andrew Hollenhorst, Lisa just killed it there last week. They were at 50 beeps. They go to 25. But the heart of the Citigroup matter, along with so many other people in the parlor game, if you will, is they will not retreat from where we're going. It may take longer to get there, and then a level in that and all the stuff you're addicted to. But the bottom line is they did not retreat from 5.x%.
Should I just say bonds over and over again, just to make sure that you have full faith in my focus?
If you get a Fed world they're talking about, I think it's price down, yield up. But
for which denomination? It sort of depends on whether people think that there's going to be some sort of recession that gets induced by that rate, and then all of a sudden people start investing in the longer-term debt. But these are the questions that people have kind of shrugged off because they believe in a soft landing, which I think seems more likely with certain of the aspects, with energy, with what we've seen with a warmer winter. But does that sort of upend this idea of the Fed backing away, which a lot of people would want to see?
John Ferro in London. We'll talk bonds with John Ferro here at the top of the 8 o'clock hour. Lisa Abramowicz, ensconced back from Davos. I'm Tom Keene. Thank you for joining us on radio and television. It's really important to book Damian Sassower in the year of the bunny. We're doing that right now. It's a Chinese. Asia's shut down, right? Year of the bunny?
It's the year of the bunny. Asia's
shut down. It's the year of the bunny.
Michael Jordan, Brad Pitt. We talked about the Sting, George Michael. They're all bunnies. They're all hopping around out there. I mean, I'm not a bunny. I'm a tiger.
How does it shut down? The entire Asia continent shuts down?
It shuts down. I mean, look, I mean, it wouldn't shut down. It's a week. It's Golden Week. It's Spring Festival. People go home. They spend time with their families.
Can they
so
do
you
that
get a lot of mobility.
COVID, the COVID. How does COVID overlay on that?
Well, we're going to find out. I think it's going to be a very interesting holiday this year, given what's going on with COVID and what's going on with hospitalizations and everything. So,
Link in your world a micro decision or choice of a China recovery into a given country. How does it impact Vietnam or Indonesia? Or, you pick the country.
Well, I heard Lisa talking earlier. She had some good conversations out in Davos about how, it's very difficult to move your business out of China entirely because you want to sell into China. And so if you move out of China, you're not going to be able to sell into that market, right? Which is a very good point. So there are some real decisions that need to be made, but rest assured, we are seeing a lot of people, re-engineer their supply chains into places like Southeast Asia, like Vietnam, as you're referring to. Although it's not at the pace, I think, many like Leland Miller and a lot would have expected. Certainly, we're not seeing the reshoring into Latin America, into Mexico and Brazil that one would have hoped for. But those currencies have absolutely killed it. And look, I mean, now is the time as an emerging market practitioner to be looking to receive in emerging markets, right? Because if you do indeed believe that the Fed's going to pause at some point in time, that means the other markets are going to probably pause as well. And you're going to look to, receive in the front end a lot of these curves. A lot of people are starting to look at Brazil, Mexico to that extent. They're looking at Eastern Europe, Hungary, the Czech Republic finally. And so, I think there's probably some legs there.
I have to say, I actually Googled Year of the Rabbit after you said that because that's what I did. And there are fireworks that come up, and it said that people who are born in the Year of the Rabbit are believed to be vigilant, witty, quick-minded, and ingenious. So just some value add there. As we talk about the reopening of China in this new lunar year, there is an issue of its effect on commodity prices, with a lot of people, from Chevron's CEO to the head of the IEA, coming out and saying it will probably boost prices of crude. How does that upend or add to some of the emerging markets bet that a lot of people are piling into?
Well, I mean, the bet has been a softer dollar. Here's the interesting thing you have to think about, right? If we do see inflation remain sticky for longer, let's call it 4%, not 2%, right? Tighter conditions are going to be here to stay. And let's just look back at the last 10 years. Well, let's look back since 1970. We've had a number of bull markets, in emerging market currencies and foreign currencies in the dollar. This dollar bull market is 4 years longer than the last two since the 1970, and it's been 11 years in running prior to October of last year. Secondly, if you look at the growth in privates as opposed to publics, I'm talking equities primarily, 11 times growth in privates, only 3 times growth in equities. I mean, it's still a pretty big number, but this just shows the amount of these liquidity conditions, these easy money conditions, how that engineered all the stuff that's out there in private land, that's going to finally rear its ugly head, I think, if conditions remain tighter for longer. So I agree with you. Rising energy prices, copper prices are up 11% year to date. Copper's up 5 out of the last 7 years, Lisa. So, if you're talking about the bull run in commodities, if you're talking about coppers and oil, I agree with you. Sticky inflation, it's going to be a risk.
Do the fundamentals matter if you get a prolonged sell-off in the dollar?
No, not anymore. I think the dollar is really the beast that keeps kicking. I'm not going to lie to you. You know, there's so much noise that go into what drives the dollar each and every day, money flows and all that kind of good stuff. But the dollar is really the kicker here. When the dollar moves, everything seems to kind of wake up and follow. You know, we could talk about fundamentals till we're blue in the face, but if the dollar's moving the wrong way, it doesn't matter.
You allude, I got to get to football here in a moment, your true expertise, but, you know, it's the only reason we had you on. Yeah. But very quickly here, what are the emerging shadows in EM? There's just barely percolating this discussion of shadow banking, shadow economy. I thought the Telegraph did a great job on this in Davos as well. What is the EM shadows out there you're paying attention to?
Well, India and Mexico have huge non-bank financial kind of sectors.
Private market.
Shadow financing, right? Which is kind of legal. I mean, they're publicly traded huge companies in many respects.
Who has risk to that? Is that like names we know, or is it?
They're in your portfolios if you own an emerging market U.S. dollar debt fund, or some of those bonds probably are in there, and wish you would be able to sell out of them at this point, because it's not really a sustainable model for funding a domestic economy, in my opinion. But you have to resort to those types of, those kinds of shadow funding kind of sectors crop up because you can't bring dollars on shore. You can't get funding external.
I've already gotten messages saying you're so gloomy and doomy. Even when things go well, you're still gloomy and doomy. Is that basically what you're saying? No, I mean, honestly, is that basically what you're saying? That people are all positive on emerging markets, but you still see the shadows out there that could potentially rear their ugly heads and lead to some sort of crisis?
I'll get a little bulled up here.
Okay,
so listen,
what's
if you
going
want
on?
to talk about the bull opportunities, and I hate to say this because I'm going to get beaten up for it, but I mean, you look at Ukraine and you look at the value and the unprecedented support for that economy. I mean, they've got a lot of dollar bonds out there, a lot of GDP warrants. I mean, some people are going to look for value there. You talk about the elections that we're seeing in Nigeria. Peter Obi, Labour Party, may not get a PDP coming in. He's promising to reprofile their debt. There may be some value there. Argentina, the whipping boy of emerging markets, is just the 29s and 30s. They announced that $1 billion buying back program went from 19 cents to 30 cents in a week. Sorry, you don't
we
care.
didn't have
no
you on
cares.
for
No
this.
one
We
cares.
talked football.
I did.
Now. There was a Snow Bowl, very different than Green Bay. It was really a sloppy, gross, ugly, clumsy game. That's fine. But let's move on to what, am I right, a dream match of Eagles 49ers? I mean, this is what the networks and all that, and I'm guessing the betting world is loving.
1.5 point spread there for those who
next
care.
To nothing.
Next to nothing.
Looked at me.
Jalen Hurts looks awesome. The Eagles look awesome. I mean, their defense looks great. But, CMC, I mean, Brock Purdy, I mean, the 49ers are good. But the real story, you hit on it, was that Snow Bowl was Joe Burrow. I mean, Joe Cool, man. I mean, he was throwing lasers in a blizzard. I don't think I've ever seen anything like that. I mean, he is awesome.
To be fair, is 49ers Eagles the real Super Bowl this year?
No. Absolutely not. I think, actually, if anything, I'm more impressed by, before Patrick Mahomes got hurt, I mean, the Chiefs and the Bengals look to me to be the favorite. But, I mean, the Eagles look good. And both games are about 1 to 1.5 point spread. So they're both going to be very tight games if Vegas gets their way here.
Is the betting just growing in leaps and bounds? I mean, has it become like a British equivalent to Premier League? Pharaoh's bet, I don't think his mother knows it, but he remortgaged her house today on Fulham and Tottenham.
So I've done a little bit of data on this. There actually is kind of geo mapping data on this. The Lincoln Field, Philadelphia. You want to talk about a city that gambles? If you could actually see the hotspots of them hitting FanDuel and DraftKings, it's unbelievable analysis.
Unbelievable.
Lincoln Field more than any other field in America by far. So if you saw what was going on in the Link, I mean, to quote Joe Slay, it was lit, man. I mean, Philadelphia was awesome.
We're always lit when Damian Sassar is with us there on the sport to come on American football and, of course, English football. John Farrell on assignment in London. Lisa?
You keep saying that, and he's saying that he's what, watching the game?
No, he's going. I think he's in the hammy stand. It's this little. It's like Wrigley Field in Chicago. It's this little tiny, completely unbuilt. I don't know.
I bet that
I wave to him when I come into Heathrow.
All I know is that he actually eats his pie correctly, unlike you that tried to do a knife and a fork,
photographic evidence
which
of
evidently is really a faux pas.
Little meatsy pie thing, somebody comes up to me. I'm sitting there with Mrs. Keene and the rock star. She's, "Thank you, Tottenham," and they're like, "Sir, you're eating the pie wrong," and they had to show me how to eat.
You do not do that. It's not like
We're going to come back. I think John Farrow's with us here because I got the pie all over my face.
That was great on radio.
This is Bloomberg. Good morning. Stay with us if you dare.
investors are really realizing now that a serious growth slowdown is probably ahead of us.
If you look at strategists' forecasts, this may be the weakest year I can remember in terms of forecasts.
This year, very simply put, inflation's peaked, yields are likely to peak, and that's what we have witnessed in the last 6 weeks or so.
The market is leading the Fed on the way up and leading the Fed on the way down.
It's a delicate dance the Fed's trying to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Welcome back. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Television. Tom Keene, Jonathan Ferro, Lisa Abramowicz. John is in London checking the weather. It is the quiet period. It is quiet because the Fed officials aren't speaking ahead of next week's meeting. But I have to say that we're actually now able to focus on the real stuff, which is the earnings that are coming through and that perhaps will justify either the bull side or the bear side.
It's an interesting week with a lot of economic data here. And I'm going to go how I started the show this morning, Lisa. We're going to get first look at Q4 GDP in 29 minutes. And I'm sorry, it's recession gloom. And we're popping on a 10-year basis, 20-year basis, normal GDP. I don't get it.
People are basically looking past the near term and saying things are going to turn the corner. And you have this sort of belief that suddenly we're going to have a good first half and a bad second half, right? The initial take on 2023 was reversed within the first week. Now, how much do we get the earnings? They either justify it or they don't. Mike Wilson continuing to say in the first quarter, we're going to see something that really pushes back real earnings and margins compression.
Bank earnings, I think, show the idiosyncrasies of it. I'll get that out. I can't pronounce it. It's like Monday morning. I'm barely awake here. But I'm sorry. Morgan Stanley, plus, your interview with James Gorman, and Goldman Sachs, and well, not plus, and a few others there. Maybe we get that through it all. Most important conversation at Davos. Let's go to it right now. You guys were brilliant with Gorman on the national debate, which is work from home. I thought that was just spectacular.
Well, right now, if you talk to any executive, they're sick of it. And that's basically what they're saying. With the work from home experiment, on the margins didn't work. On aspects it did work, and it's not going to put the genie back in the bottle. You're not going to see that, as James Gorman said. But you aren't going to necessarily get an all work from home kind of situation. Did you see all the job listings for work from home? There aren't that many, but the number of people who are looking for work from home jobs is just extraordinary as people try to reprise that kind of situation.
My theory on this, going back into the pandemic, is if you sustain work from home, you get a compensation shift because people have to travel. I mean, you know, I'm living large and fancy, and I don't know this, but many of our viewers and listeners, you add up the commute. And it's demonstrable if you're not work from home.
What was interesting during last week's discussions, even Jane Fraser, Citigroup was one of the pioneers. They were saying it's actually okay. It's nice to have flexible work situations. She talked about retraining people if they weren't performing and they were working from home. There was a feeling of frustration that I saw pretty universally between all of the executives.
Why don't you go through the data check? I'm going to look at the Bloomberg Financial Conditions Index, which is telling me we are not restrictive, and Mr. Powell has work to do.
Well, and that's what you're seeing right now. We were initially negative, but now we're positive on the margins across the board heading into the open, just marginally. Basically flat, 39.90. Are we going to get to 4,000 before all of a sudden we get some sort of reckoning, or do we just keep on climbing? You see right now with the euro gaining, it's honestly the strongest going back to November, and I do wonder how long we continue to get that versus the dollar. Strongest since April, I should say, as people look to the warmer than expected winter. How much do we also see the expectation of hawkishness from the ECB pushing that euro higher at a time when people were really positioned for weakness?
Well, I'm going to look at Brent crude up 1%. You see it right now on television. For those of you on radio, West Texas Intermediate, 82.44. Brent crude rounded up, $89 a barrel. It's a different world at $90 a barrel. And I also would point out the idea of Bitcoin printing right near 23,000. You got a feeling of that big equity lift we got on Friday. Will it surprise this week? Right now, there's no surprise. Intelligent conversation in London with our Jonathan Ferro, and he has Mr. Steely of J.P. Morgan. John?
TK, we were just reflecting on the fact that you eat a pie at a football game with a knife and fork. And I'm still trying to get my head around all of that.
It was embarrassing. People coming up saying, where's Ferro? It was John. I kid you not. It was painful.
I need to hold your hand all the time. TK, I'll be back in a second. Ian Steely of JP Morgan Asset Management alongside us today. Ian, great to have you with us in the building. I wanted to start here because I think this is really important. In the United States, ask about the debt ceiling and people shake their heads and they're like, not this again. Is anyone asking about that? When you go around and see clients in London and the UK, across Europe, are they asking about it?
To be completely honest, no, not really. Maybe there's the odd person is starting to think about it, but I get the sense there's a case of we've been here, we've seen the movie, there will be a bit of toing and froing, but the reality is at the end of the day there will be some resolve around it.
Do you think they should care?
Not yet. I think ultimately you need to wait until we're getting to the stage where actually there is going to be a material impact. That's going to be later over the course of this year. I always look at the bill market to see if there's any spikes in certain maturities. We're not seeing that yet. So the market's not really particularly focusing on it. And I feel that we've had over the last few years, this isn't the first time we've had these conversations. There's a lot of other things going on in the world before we get to probably worrying about the debt ceiling.
Well, the ultimate test of that is if the debt ceiling hits the fan, do we buy the 10-year Treasury? The answer in years gone by is yes. Do you see that answer changing?
Probably even more so now, just because actually you've got some yield on the 10-year Treasury. We were happy to buy the 10-year Treasury back in 2011 when there wasn't much yield on the 10-year, and this time there is. So I definitely think that will be the case, and the flight to quality will favour those bonds.
You know where there hasn't been any yield, and hasn't been for several decades, is Japan. I know that's a massive focus for a lot of people here in London, for you as well, looking at fixed income. There was a meeting back in December. We had the meeting's minutes, and it suggested that the government official there actually requested a recess, suspended the meeting. What do you think is going on at the BOJ, and do you think the government is happy with it?
I think the reality is, when you look at where inflation is in Japan, it's not what we've seen in the US, it's not what we've seen in Europe, but it's going up. And at the moment, their policy looks at odds with what's happening. The reality, though, is they don't want to cause untoward volatility in the market. I don't want to liken what's happening in Japan to maybe what happened in the UK a few months ago. Sure. But they don't want to see that level of volatility. So I think what we've learned from the Bank of Japan over the last couple of months or so is that I think we're going to get there, but they're going to do it on their own terms. They obviously widened the band when the market wasn't expecting it. The market was hoping for something last week. They didn't, and they're obviously doing these facilities at the moment to try to keep financial stability. We're going to get there. It's inevitable, I think, but they also want to do it on their own terms.
Two words I want to talk about, normal and market, those two words. I caught up with Jeremy Stretch in the last couple of hours of CIBC, and he said Japan's the next one to normalise. And I said, what's normal? I've got no idea what's normal in Japan when they've been doing this now for decades. The other word I want to talk about with you as well is the word market. Is there a market, a sufficient market with private demand, both domestically and internationally, for Japanese debt for when this BOJ backs away? Does it exist? Is there any sign of the one actually being there right now?
That's going to be a challenge, because obviously the Bank of Japan own a huge piece of the market, particularly in the shorter dated 10 years and in, where they've obviously been looking to control yields. So I think that's an open debate. Obviously, we're going to see the market reprice to where it should do, but the reality is there is a huge amount of securities owned by the bank, much more than any other central bank.
Where should it reprice to if we don't know if there's a market there?
So actually, what you can do is if you track the 10-year JGB yield and put it on top of the 10-year Treasury yield, and you see Treasury yields move higher over the course of last year, the 10-year JGB suddenly hit the upper bound. Before then, there was a pretty good relationship. So if you continue to track that, you're talking somewhere 70 to 75 basis points, given where the 10-year Treasury is. That probably seems as a good starting point. As I said, inflation in Japan isn't what it was in the US and Europe, but it's going up. We've got wage negotiations coming up in April. I think they're going to have to let that go.
So don't fight the Fed used to be the phrase. I know you've been reflecting on that. Should I fight the BOJ?
I think the interesting thing is, as I said, they want to do it on their own terms. So at the moment, they're trying to push some of the shorts out of the market. If you've got a long-term view, I think you can hold that, and actually yields will be higher over the medium term.
What kind of numbers are you thinking about?
On the yields, I think 75 basis points on the 10-year.
Can they go beyond that kind of number, though, in Japan? I'm looking at the things right now that are taking place across fixed income and with central banks. You're talking about the BOJ backing away from yield curve control. The ECB's doing QT. They've got officials running out all over the place saying 50 basis points, 50 basis points. I think the Bank of Greece pushed back a little bit. In that world, is that bullish or bearish for fixed income at a time where I've got pretty much everyone in fixed income saying buy bonds? All these things taking place, Japan, the ECB, QT, all over the place. Is that bearish or bullish fixed income?
It depends what part of the fixed income market you're talking about. because the US, where people are looking to buy bonds, has seen the bigger repricing. We've got more evidence over the last week or so that we are having a slowdown, retail sales. We're going to have the Fed who want to slow down from their pace. The European Central Bank, the Bank of Japan, they're behind the Fed. We've only just got to neutral in Europe. And as you said, what is neutral in Japan? Maybe we'll find out.
Got no idea.
So they need to do a little bit more. And I actually think Europe is particularly interesting at the moment because we were in a world where they were hiking rates to deal with inflation. Now, inflation's coming or likely to come off because of what's happening in energy prices. That should be good for the economy. Growth is we're supposed to be in recession in Europe at the moment, and we're not. So are the ECB going to maybe have to go slower but further as they try to battle this? So I definitely think there's a dynamic between wanting to own US fixed income and then being a little bit more cautious on some of the other markets around the world.
I wanted to squeeze this in because I asked this question earlier. I'm going to ask it all week. Does the ECB hike more than the Fed in 2023?
Yes.
Seems to be the takeaway at the moment. Incidentally, this was fantastic. It's good to see you from JP Morgan Asset Management. TK, that's two guests in the last couple of hours who have both said the same thing. This ECB in 2023 set to hike more than this Federal Reserve.
You got to see that, John. I looked at it this morning. First chart I looked at was ECB on their financial conditions index, and they are way, way behind the improvements that we've seen both in the United Kingdom and in the United States. John, if you go across the Putney Bridge today, I mean, you're out there at Fulham watching the game. And I've done my research, John, and the next time I'm there with you, I don't know why I'm not with you now. Bramo said, I just don't want to be alone. But the steak and whiskey pie at Putney Pies, and I talked to them. They said they'll even teach me how to eat it correctly.
I'll get you a pucker pie, Tom. I'll send it back. Maybe I'll get you a couple of frozen ones. Chicken and mushroom used to be my thing.
I like those.
It's a pucker pie. You
bring a brace of those back
kind of
for.
This will work well.
Bring a brace of those back for the team and
Do you microwave
Bramo
them?
and.
Do you microwave them?
So I think this is the one day of the year that I think our fans in New York, Tom, are happy that we're talking about international football and not your kind of football.
It was
after what happened with the Eagles.
It is.
We won't talk about it.
Well, I agree, and frankly, I like the pace. You taught me. I like the pace of English football versus the takes forever American football. John Ferro in London all this week with important conversations as well. Lisa Abramowicz and Tom Keene here in New York. Futures, they go green, up 6. Stay with us. Great guests in the next hour with Ferro from London.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In California, authorities are trying to figure out the motive for a mass shooting in an Asian community near Los Angeles. 10 people were killed when a gunman opened fire in a ballroom during Lunar New Year celebrations. The suspect, described as an Asian male, was found dead of a self-inflicted gunshot wound. Poland will ask Germany permission to send its German-made Leopard tanks to Ukraine. On Sunday, Germany's foreign minister said if Berlin were asked about the tanks, it wouldn't stand in the way. The failure to work out an agreement on tanks has overshadowed pledges to send more military aid to Ukraine. The Justice Department has found more documents containing classified information at President Biden's home in Delaware. FBI agents searched the home for more than 12 hours. They are said to have found classified notes from the president's time in the Senate and vice presidency. Spotify is the latest tech company to cut jobs. The streaming giant said today it is cutting its employee base by about 6%. The company has about 9,800 employees. Before today, Spotify's stock had fallen 58% since the end of 2021. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I currently favor a 25 basis point increase at the FOMC's next meeting at the end of this month. Beyond that, we still have a considerable way to go to our 2% goal, and I expect to continue tightening policy past this meeting.
To be biased, one of my favorite people now in monetary policy is Christopher Waller. He is a research horse from St. Louis. He is one of those people that was weaned on doing, creating, and reading 30-page PDFs, and he has prodigious abilities. There's all different types, Lisa, at the Fed, and he's the research wonk.
And you have the others, and they all are coalescing around a view that the Fed needs to do more, but perhaps not that much more.
Yeah, well, we'll have to see. And, of course, that dazzles on to the economic data we're going to see, including important data here this morning. Let me get that up right now. Am I right on that? We've got the leading index here at 10 o'clock, and then tomorrow we go into a raft of economic data staggering to the 26th of the month. And to me, that key first look at GDP. Futures up 8, a little bit of lift to the market, just like what we saw on Friday as well. Dow Jones Industrial Average, 33,547. We're buttressed right up on 4,000 on SPX. On the equity market now, Gina Martin Adams with a brief here. And Gina, I want to go back to my great mentor in London, Meghdon Desai, with a definitive book on Marxist history and on the travails of capitalism and The Economist. Meghdon Desai, Lord Desai, has always said profitability, it matters. Where in your world do you see profitability? Is it net income or is it up the income statement?
Yeah, I think this is a great question and a really key question for 2023 in particular, because last year, 2022, was really about shrinking margins, particularly relative to expectations. The analyst consensus is anticipating rising margins through the course of 2023. We have started to see, actually, in this earnings season, company cost cutting is what is really driving the earnings beat. For the first time in a long time, companies are actually missing on sales. So for the first time since the first quarter of 2019, we are seeing the S&P 500 miss the sales expectation, but nonetheless beat the earnings expectation because of those cost cuts. So profitability is becoming a very important factor for performance. And I do think that we'll see that continue to perform all year.
And I want to pin you down on this, and I understand sector to sector, particularly banking is an X, it's nuanced. But if revenues are lighter because of disinflation, let's suggest, and we come down to gross margin and then various and sundry CFA margins, and then we waltz over to free cash flow, which measure of profitability is the one to study?
Yeah, so we track operating margins very closely. And to your point, that's very difficult to do when you're thinking about the financial sector, which you really have to analyze separately. Nonetheless, we do look at operating margins. We analyze the operating margins for 9 of the S&P 500 sectors, excluding financials and real estate, of course. And intriguingly, operating margins are on or beating expectations for most sectors so far this season. Now, what's most interesting in the broader landscape is the reason for the sales miss. And I think that that's really important to understand. Why are companies missing sales and what companies are missing sales? And most of the miss is because of the decline in commodity costs. So we're seeing it concentrated in expectations for energy and utilities companies, as opposed to the broader index, which has serious consequences for what you're thinking about in terms of an inflection point on earnings. We believe that 2023 will be a year where you see earnings inflect more positively into 2024 because of this margin dynamic. But I think we want to watch really carefully over the next several weeks of earnings season. You know, we really kick off earnings this week with about 90 S&P 500 companies reporting. We see the next 3 weeks as the most critical and most consequential for really framing that outlook for an inflection point on margins, an inflection point on earnings in 2023.
So what do you make of all of the narratives, Gina, that you have companies that aren't going to lay people off, not necessarily in the tech world, but elsewhere, because they couldn't get workers during the pandemic and they've been scarred by that. So they're not going to lay off workers to cut costs, and they're just going to see it in their margins. Is that basically a myth, or are you starting to see that?
Well, I think that it is very industry by industry, Lisa. You're correct to point out that a lot of the cost cutting so far and the layoffs have come in the tech space, where we saw some of these tech companies double their workforce over the course of the pandemic. So they're seeing, you know, we're seeing somewhere between 5 and 10% layoffs into 2023. I do think it is industry by industry, sector by sector, though, because there was limited overhiring in some segments where they couldn't find workers. So they're not going to necessarily get the margin benefit. Now, when you look at the true weakness in margins and you focus on the operating margin lines, the areas of weakness were concentrated in the tech space. It's the communication stocks in particular, but also the tech companies, to a lesser degree, consumer staples companies and some consumer discretionary companies where you have some issues with margins. Those are the 4 sectors I think you watch most carefully. The rest of the index is going to be less about margin, significantly more about sustaining revenue growth as we go through the economic cycle. But it is not, we can't paint the whole index with one big broad brush when it comes to this issue. It certainly is much more idiosyncratic risk at the company level, and then even broader at the industry level.
Gina, I was reading Mike Wilson's comments over the weekend, and he's been pretty consistent in his message. And he said, the question is, when will equity indices price the current weakness in the leading data and the eventual weakness in the hard data? They believe it's this quarter. How do you push back against that if you don't necessarily believe that you're going to see that margin compression?
Well, I think we all can sort of argue about how much was already priced, frankly, in 2022. Our models would say that in the downdraft that we saw in June and then again in September and October, we already priced a pretty significant earnings recession coming into 2023. It's a difficult time in the cycle, frankly, because investors are scared of this word economic recession, but the reality is the earnings stream has been in recession for more than a year. We look at overall unadjusted earnings. They peaked back at the end of 2021. They're down about 7%. The analyst consensus is already expecting them to drop double digits over the course of from peak to trough. So there is a degree of weakness that has already been priced and also is already anticipated. I think we're starting to see that with the earnings season, where company beats are being rewarded at double the average pace. Company misses are certainly not being punished with stock price declines. And from that respect, it would suggest we've already priced a strong degree of weakness. I think you do have to have further evidence that things are going to get much, much worse for stocks to react extremely negatively in the first quarter.
I mean, Gina, very quickly here, we're gonna run out of time, but I got another lift in the market. I've got Dow futures up 88, SPX up 9 as well. We saw the big lift on Friday, and all I do is go back to the gloom of 73.74 and whammo 75.76 back-to-back 2 years. What precludes that from happening again?
Well, I think the inflation dynamic certainly reminds us all of the mid-70s or even the early 80s, which was a lot of volatility and inflation, certainly whipped around stock prices. That said, I think you do need to understand where you are in the economic cycle and what has been priced by the equity market. It is extremely important to understand that equities do precede the economy. Equities do price what is likely to happen in the economy over the next 12 months. Over the prior 12 months. So what we're doing in the equity market analysis that we do now is saying, where are we going to be in 2024? Because that's important to consider for framing your outlook and for your positioning. And frankly, our work would suggest we will be in that early cycle recovery by sometime in 2024. That means 2023 is an inflection year for the US equity market, where you start to rotate into early cycle sectors. You start to think about where the value has been unlocked. But you have to do so on a company-specific and industry-specific basis when valuations are as high as they are and inflation risk is still relatively high.
Gina, thank you so much. Gina Martin Adams to get us started strong on Monday on the equity markets. And again, a big lift on Friday. Late. Some people missed that. In red on the screen, and now Lisa reversing futures up 9.
That was my fault, you're saying? Basically, I'm back and so things are bearish. Like Lisa's reversing futures. I do wonder, though, when is bad news bad news? And we asked about that last week, and this will be a week of discussing that as well.
Bramo's back. We'll analyze when is good news good news?
Sure, that's the other flip side.
We'll do that. Claudia Sahm, anticipated. Stay with us. Bloomberg Surveillance Monday morning on radio and television. Thank you for joining us on economics, finance, investment, and international relations. Haven't even touched on Ukraine and the tank debate that went on all weekend, and I would suggest picked up and got some steam to it. John Ferro in London, look for his effort here in 30 minutes as well. He's got a great set of guests lined up. I noticed, I believe, Christian Momani will be on there, who's got real money at risk and has to make real allocations forced into the market. Cash is not a luxury for Dr. Momani, and that'll be interesting. An interesting conversation. Lisa Abramowicz rumored back from Davos. Is there Let Jag? Do you have Let Jag, or are you back?
I don't know. You can judge. You can judge me in about a half an hour and tell me whether I'm jet lagged. It's great coming back from Europe with the jet lag actually being somewhat convenient for our schedule.
It is. It works out as well. Lisa here, and we'll get through the week together. Mr. Ferro, again, in London. That's a good thing given all that's going on over there. Lisa mentioned the labor unrest in the United Kingdom as well. Futures up 6. We had read on the screen earlier, there's a little bit of a pop to the market. The VIX right down on a 20 level. Don't want to make too much about it, but we're watching with yields higher. I'm going to call it a more constructive tone in the market. And let's round it up. $89 a barrel on Brent crude. Maybe that's the thing to watch into February. And I would note a Bloomberg Financial Conditions Index, which is miles from restrictive as well. This is a joy. She's hugely controversial. Always brings up a fire of emails and social and Twitter and the rest. She's Claudia Sahm, who was Michigan economics and really thoughtful about this identification of inflation, the link to the labor market, some of the older theories that maybe don't work, and some new research that needs to be done. She's, of course, with Sahm Consulting and a former Fed Reserve economist. Claudia, let me go. I want to get to a more thoughtful thing, a more theoretical thing, but in your note is something that is ancient. High inflation cures high inflation. That is foundational. Discuss that concept.
Right. Well, we have to remember the Federal Reserve does not set prices. Right. What we see is they're in there, right? They're raising costs of things like borrowing, which are important in decisions. And yet this is an interplay of hundreds of millions of American consumers and tens of millions of businesses. So as someone who followed consumer spending very closely in my 10 years at the Federal Reserve, the retail sales last week were kind of a punch in the gut, right? The American consumer, this is 70% of GDP. And yet, this is mainly goods spending, and businesses need to get the signal, like consumers will get price sensitive. So this is the idea of the high inflation. At some point, the consumers pull back, and then the businesses, they got to price it in and at least tamp down that inflation and maybe even cut some prices.
There are the two M's in academics. There's the University of Michigan and all the great inflation work done there over the years, and also a small startup school on the banks of the Charles River in Boston, Massachusetts Institute of Technology. Claudia, I want to talk about Olivier Blanchard's new effort, which I think you're in close link with, which really says we need a more rigorous analysis and less a fad-driven analysis of where we are. In the heart of what Olivier's saying is we think the Fed has too much power and that there are other broader long-term factors moving this great disinflation, like demographics, just as one example. Do we put too much weight on the Fed in terms of their ability to fix things?
I think that's absolutely the case when we think about the real economy. The Federal Reserve has big effects in financial markets. That is absolutely the case. And yet their mandate is in inflation and in full employment. And that's been my big attempt is to draw attention to the fact that one of the reasons that we've had so much inflation is our economy was not resilient. Whether it was supply chains or we had underpaid workers, and those are not levers that the Federal Reserve can pull. And we have learned in this crisis, fiscal policy is powerful. Something that's powerful, we should spend a lot of time getting it right in terms of how to use that. The Fed we've learned a lot about the Fed, but it is not our most powerful tool.
Well, I want to just say, Claudia, last week, one of the conversations, not on air, behind closed doors, of executives of companies worldwide were not blaming the supply chain disruptions. They were blaming the last payment that was made out in 2021 to stimulate an economy that already was flush with cash. And they're saying it's going to take time for that to work through. But that was the main driving factor of inflation. Do you disagree?
So it's the beginning of 2023. It's absolutely in the mix, right? And this is the thing about, we learned that policy was very powerful. We also took a big dent in consumer spending when everything shut down. There's still a lot of pent-up demand. I think we forget this time last year, we were coming out of an Omicron wave that really was affecting, if nothing else, keeping workers on the job. And then we were hit by the war in Ukraine. Right, there have been some really important disruptions to the economy, to our daily lives since those stimulus checks went out. And frankly, you can only spend those once. right? So there's actually been a drag on fiscal policy that probably has a lot to do with some of the weakness we saw at the end of this past year.
Well, Washington is pretty much in gridlock, so there's a lot of not a lot of faith that they're going to actually do something on the fiscal side to address further beyond what they did with the Inflation Reduction Act and beyond, based on a lack of fiscal impulse and what's going on the monetary side. Do you believe in the soft landing kind of scenario, or do you think that that is overly optimistic based on the empirical evidence that people point to on the margins of a slowdown?
So I worry some about just using the word soft, right? As we come out of this and inflation comes down, this is going to be a bumpy ride, right? We had 3 months of really encouraging data on inflation. If you really think every month after this is going to be a smooth sailing, I think you're deeply misguided, right? This was something that Vice Chair Lael Brainerd said towards the end of December when she questioned some of these simple models of inflation, like this is going to be a bumpy ride. Now, I think, to me, it's not as much about the soft, quote-unquote, soft landing. 2023 needs to be a path back to something that looks like pre-COVID normal. And it was very disruptive getting away from normal, but I think that's the goal. And the Fed needs to see that, right? It's not just about hitting 2% inflation at some magical point in time. They really have to believe that it's sustainable.
If we're trying, Claudia, to get back to normal, and I think that was a great theme at Davos and greatly a great theme of the show that we've done here in 2023. Part of that is that there'll be change. There'll be technological progress. Maybe there'll be government support, particularly in Europe with the war. That's all fine, but it pushes us away from the gloom or caution of secular stagnation. And that started with Alvin Hansen years ago. Lawrence Summers has picked it up to great effect as well. You've really pushed against that. There's a solemn optimism that we can get back to normal and move beyond secular stagnation. Discuss that. How do we do that in the coming 12 months?
Well, I think if nothing else, the past 2 years have put a big question mark on the idea that we're just in this low growth state. I mean, for the first time in several decades, we had a job-full recovery, right? So the idea that there's just something fundamentally dragging down the economy, I think we should put that into question. Now, when you mentioned the broader trends before about demographics and technological change, I mean, these could be weighing against that recovery. And yet it's also the case that we were much less destructive to workers and businesses through this recession. And that matters in terms of, do we have long-term scarring or do we have some long-term oomph to this economy?
So what are you looking at data-wise? And we get a slew of it this week, heading into next week's Fed meeting. What are you looking for to know whether we're going one way or the other? In other words, the most telling of the indicators.
So I'm absolutely looking at what services spending, what we see, because again, the retail sales was really weak. That could be a rebalancing from goods back to services. We need to see that. And then once the consumer is rebalancing, business rebalances, workers rebalance, right? We've got to take some pressure off of places that don't normally have a lot of spending. And yet if we see services spending that looks like what retail sales did with, a 1% drop, like that's a big red flag in terms of we're losing the consumer. So that's a big piece of it. Obviously, I'm looking at wages because the Fed is looking at wages. And yet they're slowing down. I think the Fed's goal this year is to be boring. And I think they're on track for it. The world is probably not going to be.
Okay, let's make a pact, Claudia. The Fed can be boring. You can't. Claudia Sahm, thank you so much with Sahm Consulting here, and always controversial, pushing against some of the main tenets of economics. She really lays out the arguments that are going to be had. And again, as I got to bring it up here, I'm sorry, folks, I don't have them memorized. We're all fixated on February 1. I want to get out to June 14th, July 26th. Does anyone have a clue what those Fed meetings will look like? The answer is no.
But people are trying to figure out whether the Fed gets to 5%, whether it's in 25 basis point increments or not, and then holds, right? And just remains there for a longer period of time, which means throughout July, throughout September, going through there and not necessarily cutting like the market is pricing in. What I find interesting is some of the empirical data. If you take a look at job searches, they're taking longer. There's a Wall Street Journal story about that. There was a story about how a growing number of companies responding to a survey are planning job cuts outside of the tech sector. So there is this pressure that just isn't yet showing up in the numbers. And how big that pressure is just remains to be seen.
And what's so important here, and it really doesn't depend on what you're looking at, but in terms of caution, not gloom, but caution into some form of economic malaise or economic soft landing or economic slowdown, contraction, recession, is it happens quickly. There's a huge respect across all opinions, Dr. Sam, Dr. Summers, and the rest, that, to your point, when it goes into the Fed, 3.5%. Do they get out to 4.5% inflation, or does it unravel from there?
The snowballing effect, because if somebody gets laid off, they can't spend as much, and all of a sudden you get all of the negative impacts that are feeding on each other, which could lead to some sort of bottom, some sort of catharsis. I'm wondering, since people are saying it's going to get pushed out, does that mean it will be short and shallow? I mean, that whole discussion that seems to be consensus, or will it be something different than that?
We'll have to see. The agreement we have is markets go down, Bramo does a data check, markets go up, I do the data check, so I'll pick it up here. Futures up 7, Dow futures up 82, the VIX 20.06. I think that, I'm sorry, it's important. Bitcoin on the edge of 23,000 for those keeping score. Brent crude rounded up, $89 a barrel, up a stick. That has my attention. Dollar stronger after a weaker dollar morning. Please stay with us. Jonathan Ferro in London coming up at the 9 o'clock hour. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In California, authorities say the suspect in the shooting deaths of 10 people in an Asian community near Los Angeles has killed himself. The attack took place in a ballroom during Lunar New Year celebrations. It's believed the suspect, described as an Asian male, tried to carry out a second attack nearby. In the UK, ambulance workers are walking out today in the biggest strike by first responders. Trade unions are protesting pay levels in Britain's National Health Service. They're demanding a double-digit pay hike. In France, President Emmanuel Macron's government is moving ahead with its pension reform plan despite threats of more protests. The proposal would raise the minimum retirement age from 62 to 64. More than 1 million people took to the streets last Thursday to protest the plan. More are set for next week. Bloomberg's learned that President Biden will name Jeff Zients as his next chief of staff today. Zients is a former business executive who was one of the chief architects in Biden's initial COVID team. He'll replace Ron Klain, who will leave in the coming weeks. The White House chief of staff is among the most powerful figures in Washington. And hedge fund Elliott Investment Management has taken a multi-billion-dollar activist stake in Salesforce. The firm says it's looking forward to working constructively with the business software company. Shares of Salesforce have plunged since their peak in 2021. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We're not seeing huge demand into high yield so far this year. What we're seeing, I think, is more technically driven. There's no supply. We are still anticipating a widening of high yield spreads when that recession comes, and timing that recession is difficult, but when we do see that recession, spreads tend to widen to at least 800 basis points.
Kelsey Barrow of J.P. Morgan inspired. We've done a lot with J.P. Morgan recently, and I must say they've got a diverse set of opinions, all centered around attempting to game a recession. John Farrell getting ready in London for the 9 a.m. New York time hour. Lisa Abramowicz and Tom Keene here in New York. Lisa, I go back to NBER, what Mr. Podesta's doing there, and the idea of 2 quarters of decline. You know it's a recession way after it is a recession. But can we say we're in a recession right now? I hear a lot of people walking away from that.
Because there have been a number of surprises that have been to the upside, right? China reopening, people viewing this more as the positive than the potential inflationary impulse. And then you have warmer than expected weather, which has really helped Europe. So a lot of people think we're okay. Does the GDP print change anything? even if it's technical, that we get out on Thursday.
We're going to have to see. And to me, and this goes to the economic data, which is first seen in the bond market. Let's cut to your expertise. What have high yield spreads done after your sojourn in Europe? The answer is they can continue constructive, right?
They were constructive, a little bit of a sell-off when you had a little bit of the wobble in equities, and then constructive once again. People seeing the opportunity for yield more than the opportunity for default. And that, to me, highlights how people are looking through this and seeing corporate strength regardless of higher financing costs and potentially weakening consumers.
Very good. What we're going to do right now is speak to someone who invented it. I really can't say this enough. I'm going to go back to the shock and awe of point and figure charts of 1880 and through the early part of last century. And then in the 1940s, there was dropped upon us someone who said, you can plot a stock and you can draw lines of support and resistance. His name was John Magee. One of his great disciples was Ralph Ancampora. To say he's a chartered market technician, co-founder, barely describes his contribution to looking back at what price tells us about forward. Ralph, honored to have you with us today. I want you to discuss the modern idiocy over catharsis. We need catharsis to make a bottom in the equity market. Have you observed catharsis that drags us out of this bear market?
Absolutely, Tom. Thank you for that kind introduction. I have to stress October 13th, Tom. The Dow had an intraday price swing of 1,502 points. No one's talking about it. In technical parlance, that's called a key reversal day, when the low of the day and the high of the day precede the previous day's high low. And that, to me, was a major turning point. And since that October low to the December 13th high, the Dow is up about 21%. The S&P is up about 18%. So there's been a nice recovery. And since then, the market's been consolidating. I think we're making a bottom long-term in this bull market.
Ralph, the study of technical analysis, with great respect for Dow theory and the rest of it, was done at a time of non-derivative instruments. We now live in a world of ETFs, of massive indexation and all. Do the formulas of support and resistance that you helped invent, did they work in this time where the New York Stock Exchange really isn't the New York Stock Exchange we knew?
Yes. I appreciate that question, Tom. But remember what technical analysis is all about. It is following the laws of supply and demand, buyers versus sellers, and that has never changed. The emotion of investors has never changed. Fear and greed is all manifest in what we follow. So if you believe in price, which I do, I don't own an indicator, I own price, and I follow the trend of price. Buyers push them up, sellers push them down. It's that simple.
Ralph, on the spectrum of risk versus fear, of risk appetite versus taking all your chips off the table, where are we?
For me, I've become very aggressive coming at it at October 13th low. And I think since then, if you look at foreign markets like Europe and you look at emerging markets, they have been leading the U.S. market. So I think it's broadening out. So I'd say put chips on the table, play the game.
What makes you feel like this has staying power, like this is the early stages of something more sustained versus a head fake ahead of something that a lot of people say is a necessary byproduct of monetary policy?
Good question. Remember I was talking about October 13th low, and it rallied in 2 months to December 13th high. And that since December 13th, we've had a pullback. The Dow has dropped about 6% or so. I think the S&P had an 8% decline. And those levels right there, we are looking at, that would be 32,581 on the Dow and 3,764 on the S&P. Those are very short-term support levels. That's where the buying should be in. I keep my eye closely on that on a short-term basis. And I think we're holding up well.
Ralph, I want to get back to the arch issue of the day, which is the failure of the American retirement system, because people are in and out of the market. We're at one of those moments right now where millions of people are literally saying, how do I summon the courage to get back into the market? And I'm going to go to the crew that you and I are weaned on in Larchmont, New York, Mike Burke, Chartcraft, Mr. Cohen's work, and of course, Earl Blumenthal. They knew when to have the courage to get into the market. How do you get into the market like you did in 1975?
When you say get into the market, you mean participating and trading?
I'm in cash and I need to go long. How do I get back into the market if I'm scared stiff?
Well, again, again, being a technician, I think you got to look at levels. And I think in the days ahead, literally, excuse me, in the very short term, the next couple of weeks, just watch, because we're in the early seasons right now, and we still got a lot of dialogue about whether it's a recession or not a recession. And you got the war in Ukraine. If we can hold above that October low, which I think we will, that to me would be the final test. So in the next couple of weeks, volatility, we hold above those lows.
Right.
I think looking out towards the second half of this year, I think we're going to be in pretty good shape.
Ralph, never enough time. Ralph Encampora there on technical analysis. Just an honor to have him on with us today. Lisa, I can't say enough about the legacy of this and the idea of what technical analysis does for you. It's one of the first heated conversations I had at Bloomberg, and with great honor to the late Gary Turkle. Bloomberg has terrific technical analysis as a general statement. What this is about is trend. You're not in the market. How do you get on the trend? How do you stay on the trend? And when do you have the courage to get off the trend? And of all the people we talk to, the one that alludes back to Ralph Encampora is someone like Chris Verone at Strategas.
To me, it's interesting to hear how you can judge in some sort of more objective sense that spectrum of where we are versus fear versus greed. And that's been a huge issue of contention at a time when a lot of people are looking for the silver linings and finding them in real developments versus people who say it is very hard to see how this monetary policy can end up with something that is an optimal
In my
outcome.
experience on this within the daily surveillance babble that we do, John doesn't do babble in London. We'll see that coming up. But Lisa and I do babble here in New York. It's wildly asymmetric in that Ralph Enkampora's world, maybe it doesn't help me get into the market. That's a different set of decisions like what Bramo's saying on TV today. But boy, does it help when you want to get out of the market. That's really where technical analysis does much better.
The death cross and things like that.
She's pushing my buttons. Joel, do something about this.
You told me that I go blah, blah, blah.
The death cross, the death cross is, I don't know where Ralph is on this. It's absolutely useless. Don't get me going.
It's a very hard moment. Okay, well, right now, to look at the fundamentals, it's hard to get a handle on the fundamentals, which is a reason why technical analysis perhaps is interesting to look at as well for a feeling of the supply and demand that Ralph was talking about.
I'm in the world with Edward Hyman and the wonderful John Murphy. You got to use them all. Technical, fundamental, and a little bit of economics overlaid on top.
And just say bond,
Some people
bond
don't
over the top of that.
Next, Ferro in London.